Make sure we're monetizing this. Oh, yeah. Oops. Cool. All right, all right. All right, I'm a talking pumpkin. I'm a talking pumpkin. Hey, Tim Smith, right on with the Redskins. Number 36, Super Bowl champ, Timmy Smith. What happened to Timothy Smith? The real Timothy Smith. Just goofing on you, brother. Now we're gonna get started. I want to gotta make sure I'm making that sweet, sweet YouTube money. Ah, man, I bit my tongue. It hurts like freaking HE double hockey stick, man. All right. There we go. Blink. Angelo, que paso? Looks good. All right, all right. We're gonna go over here. Kevin, what's going on in Arizona? Marty, what's going on in Oregon? Oregon Trail. All right, cool. We're good there? Hold on a second. All right. All right. All right. Cool. All right, good job. Gordon? Okay, Paso. All right, so first, I forgot to bring my Days of Praise book with me when I went to down in Alabama. So I want to read real quick from the Days of Praise, the daily gospel stuff here. And if you guys, no one has to be here. It's your choice, but I love the Lord. And if loving the Lord is wrong, I don't want to be right. So I'm going to get my reading glasses on. And this is from Friday, March 19th. And this Days of Praise, they give you these little daily 3-4 paragraph little topics there, which is freaking awesome because it just puts you in the mood to start the day. I'm telling you, man, it's fantastic. And this is from the Institute for Creation Research. You don't have to be a young earther, a creationist. I don't subscribe, and I don't not subscribe. It's just, frankly, for me, I got more things on my own trying to fix this guy than worrying about what God's plan is for the entire world. I just got to get right with God for me before I can start saying, oh, my goodness, you're wrong. God didn't do that. And I tell you, man, I think we get caught up in a lot of stuff out there. It's like, look, the way I look at it, the big guy upstairs, he knows a heck of a lot more than I do. And I just say, look, I just get on my knees and I say, Lord, just guide me the way you want me to be and give me the strength to follow along, man. Exactly, Robert. The love of the money is the root of all evil. The love of the money. It's not money. I hate when that. I hate money's not the root of all evil. It's the love of the money. All right. This is love's longing prayer. So Philippians. And this I pray, that your love may abound yet more and more in knowledge and in all judgment. So Paul's longing for the Philippian church is eloquently expressed in his prayer for the maturation in the faith. It begins simply with a prayer for the growing love that will abound yet more and more. This phrase is only used 2 other times in Colossians 1 Colossians 4, 1 and 10. That God's love will abound yet more and more. Thessalonians, Essentially, the prayer is that their love would never stop increasing. The focus of the ever-increasing love, however, is not emotive reactions or depth of feeling. It is nonstop, ever-growing love for knowledge and judgment. Nonstop, ever-growing love for knowledge and judgment. And as one might expect, the Holy Spirit's choice of words is important. Several Greek words can be translated as knowledge. The specific choice in Philippians 1:9 is epignosis. A term that emphasizes understanding of facts or truth and carries an intensive meaning with a fuller, clearer, more thorough knowledge than mere awareness of data. Oh, man. It carries knowledge, understanding of facts or truth, which carries an intensive meaning with a fuller, clearer, more thorough knowledge than mere awareness or data. A person with epignosis knows both what and why they have certain facts. Judgment is a translation of aesthesis, an unusual term that demands perception, understanding, discernment of what to do with the knowledge. Both terms are intellectually based and require a growing grasp of information, but both are the product of love, not of human standards or high intelligence. Oh, man. We must be rooted and grounded in love and speak truth in love and always be conscious of a relationship so we increase the edifying of itself in love. Finally, there's this overreaching statement: God is love, and he that dwelleth in love dwelleth in God, and God in him. So that's from Friday, March 19th. You can see right there. So now we're going to go on to Saturday, March 3rd. See, look how quick that was. I don't have time. You don't have time. You got to make time, man. Trust me, I'm the biggest hypocrite there is. I act like, oh, I love Jesus, and yet I don't have time for Jesus. I should be putting Jesus at all costs before everything. I don't. Stupid, but I mean, because I'm a friggin' hypocrite. The price of sparrows. Are not 2 sparrows sold for a farthing? And one of them shall not fall on the ground without your Father. That's in Matthew 10:29. This fascinating bit of first century pricing information seems so trivial, provides a marvelous glimpse in the heart of the Creator. Of all birds used for food by the people of those days, sparrows were the cheapest on the market, costing only a farthing for a pair of them. In fact, they cost even less in a larger quantity. For on another occasion, Jesus said, are not 5 sparrows sold for 2 farthings? And not one of them is forgotten before God. The farthing was a tiny copper coin of small value. So a sparrow was all but worthless in human terms. And yet the Lord Jesus said that God knows and cares about every single sparrow. God had a reason for everything he created. Each kind of animal has its own unique design for its own intended purpose. Modern biologists continue to waste time and talent developing imaginary tales about how those multitudes of different kinds of creatures might have evolved from some common ancestor. Even some evolutionists have started calling these whimsical tales just so stories. They would really be better scientists if they would seek to understand the creative purposes of each creature rather than speculating on its imaginary evolution. I agree with that. The better we comprehend the amazing complexity and purpose design of each creature, the better we realize the infinite wisdom and power of their creator. Then all the more wonderful it is to learn that their creator is our Father. He has placed them all under our dominion, and we need to learn to see them through his eyes if we would be good stewards of the world he has committed to us. We can also thank our Heavenly Father that we are more valued than many sparrows. All right, that's freaking spot on, man. I tell you. More value than any sparrow. The idea, right on. The idea that humanity is evil. I said this in a live stream, not a live stream, but a video I did today while I was driving. The idea that we are, that there's any human that is not valued is nuts. And I always say this, I say, look, man, Jesus didn't die. He died for us all as individuals, not as a group. And this is the whole thing what's going on in the United States now. The whole thing in the Western civilization is that the whole thing with Western civilization. Don't ask me, Robert. You pray to God for that. Robert says, should I tithe on my investment gains? Man, that's between you and the big guy. You got to get on your hands and knees and seek guidance. Well, literally, I don't know what you should do. But the idea that somehow I'm part of a group as opposed to part of an individual with an individual unique relationship with God is not good. Anyway, so God bless. Hallelujah. It's I tell you, the best thing about being of Jesus is that you know how it ends. And it's scary. I mean, my goodness. I can't guarantee that Jesus, I can't guarantee Jesus lived, and I can't guarantee he died, and I can't guarantee he resurrected. I have no idea any more than you have any idea about evolution or anything. We don't know. You don't know what happens to you. No one does. That's where faith comes in. So we all have faith, man. But it's okay to admit that. It's okay to admit I don't know. And it's a wonderful thing. When you say I don't know, and you say, God, I got faith that you're going to guide me. It's amazing too. And it's amazing too how much when you start living in faith, how much just pressure is taken off. It's nuts, man. I tell you, it's look, I can't guarantee you this. The more you give, the more you get back. It's the weirdest thing. I'm telling you right now. The more you give away, the more you get back. And it's that doesn't mean, you give $100, you're going to get $200 back. I don't mean like that. It could be, I don't know. But it's just like what happens is the more you give, the more you get back in terms of the joy in your life. Oh my goodness. Giving is it's such a great thing. It really is. All right. So God bless. All right. So I want to start with this one article that I had found. We're going to find this right here. All right. From inflationdata.com. Who does inflation hurt the most? All right. Hold on a second. All right. Here we go. This is an old article. All right, so the reason I bring this up because I think it's interesting. I don't want that. I want to make it a little bit. Oh, there's every socialist is a disguised dictator. Absolutely. Have you guys been following the path of the old president of Tanzania? They used to have in Tanzania. They used to have an old tyrant, and the new guy who was I liked him a lot, and just magically he died. Very interesting, man. Very, very interesting. The president of Tanzania just died. I forgot the old guy's name, and I can see it in my head. I want to say it's Joseph N.Y. something, but I can't remember off the top of my head. Just not a good guy. This is a long time ago. And this new guy, I liked him, and he just magically died. Very interesting. Anyway, it's kind of interesting. And we have if you're not following my man Anomaly in hip hop. That guy is, I tell you, man, we got some good dudes out there, speaking some serious truth bombs. Anomaly, that guy, nuts. He's freaking spot on. And if you're a Trumpster, you're not going to like him because he's like me. He hoped Trump would win, but he said, wait a second, this last year, Trump kind of let us down, let me down, let him down. It's interesting. That doesn't mean I don't like Trump. I still wish he won. The cleanest election of all time, guy who can't even walk up the plane ramp, won, most popular president ever. But anyway, at the end of the day, it's very, very interesting because there's some righteous dudes out there who are willing to say, hey, this is some problems with the Trump side. Obviously, the left has gone nuts. But anyway, watch my man Anomaly. I love that guy. And if you're on Facebook, apparently he's got a pretty big Facebook presence too. All right, so let's go into this here. Who does inflation hurt the most? This is something that you learn in basic economics. Well, I shouldn't say you do learn that because you don't, but you should. This is from 2007. All right, so let's. This is from inflationdata.com, and I thought it'd be fun to read this just simply because I want to see what they were saying back then. All right, who does inflation help and who does it hurt? All right, so we know I'm going to share with you who inflation helps from a basic economist perspective or economics perspective. Inflation always helps those who get the money first. It always helps the government. All right, always helps the government and always helps the people in the know. Why? Because they are the ones who get the money first. They can buy more goods with it before the cost of goods go up. It's such a friggin' scam, inflation is, but it's just a lobbying power of the political insiders. It just always is. They get the money first. They get to spend it before the currency gets devalued and prices go up. It's such a scam. All right. So I have yet to read this article. I figure we'll see what this guy says. All right. When we first think of inflation, we assume that'll affect all people equally. Nope. After all, everyone is using the same dollars. Wouldn't everyone be affected the same? The fact, of course, is that everyone isn't affected equally. Our second assumption might be that the poor would be hurt the worst because they earn minimum wage and everything they buy is getting more expensive. However, if the minimum wage is indexed to inflation, they would about break even. So interestingly, if the minimum wage earners are deep in debt, inflation actually helps them. Could not agree more. It's not just the minimum wage earners, it's anyone who's deep in debt, inflation actually helps. You would think. I mean, from basic, my house, that I got a $200,000 mortgage on. Inflation will eat away at that $200,000 mortgage. And as such, the people who are paying or are on a fixed income, I should say, the bank who loaned me that fixed mortgage, or if you're on a fixed income that's not inflation adjustment, inflation destroys you. All right. So interestingly, those who are deep in debt actually are helped by inflation, which is who's the biggest debtor out there, my friends? You want to take a wild gander? The U.S. government. And because the U.S. government is the biggest debtor in the whole world, don't they have an incentive to see inflation? Yeah. You think Japan doesn't have the same incentive to see inflation? They do. Then why can't they get inflation? Interesting. The reason for this is that debtors borrow valuable money, and the number of dollars they must pay is fixed. So over time, the value of the dollars they must repay is less and less. This is called repaying with cheaper dollars. Exactly. Because the dollars are being deflated, devalued, inflated, devalued. However, bigger beneficiaries would be the average middle-class person with a large mortgage because the debt is for a longer term, so inflation has longer to work its magic. Typo. I'm going to be a freaking typo Nazi. It's not it's with apostrophe. Yeah. On the other hand, the biggest losers due to inflation are those willing to lend money. Exactly. The lenders and those on fixed income. An example would be the hyperinflation of 1923 in Germany. And that's, let's see, one of these books I just got. Yeah, right here from a man, James Grant. Oh, yeah. Oh, we got so many books to read. I can't even begin to right here. We got this book right here, Money of the Mind, Borrowing and Lending in America from the Civil War to Michael Milliken. I cannot wait to read that. James Grant. Hold on a second. Let me move some of those books over so I can have more elbow room. If you had loaned a friend money to buy a car in early 1923 and he repaid it at the end of 1923, you might have been able to buy a box of matches with it. So it's easy to see that the borrower got a car and he was able to repay it with pocket change. The lender was the big loser. Yep. At first, this looks like the ultimate Robin Hood scheme, robbing from the rich bankers and giving to the poor borrowers. However, the other big losers are those on fixed income, like the elderly or anyone whose income isn't indexed to inflation. Inflation affects them especially hard because the prices of things they buy go up while their income stays the same. In addition, the poor are generally renters, so they don't even benefit from a cheaper mortgage because they're paying for higher rents that go up with inflation and higher prices for groceries and other goods. Also, even though their wages may be indexed to inflation, there's a time lag since it's usually only re-indexed once a year. Yep. During this time, they're on the old wages while prices for things are jumping up. Here you go. Interestingly, the biggest debtor in the world is the U.S. government. And is also the biggest beneficiary of inflation. Right on, man. And not coincidentally, the government is also the one who controls the money supply and thus the inflation. In a way, inflation works as a hidden tax because the government borrows money from investors, it spends its valuable money, and then gets to pay it back with cheaper dollars. The poor, unsuspecting investor who is convinced that the government knows bonds and T-bills are low-risk investments, accepts these dollars at face value, but before long realizes they won't buy as much as the dollars they loan to the government in the first place. Generally, the government walks a tightrope. It can't inflate all its debt away too quickly without destroying the economy, so it faces a constant balancing act. One of the biggest disadvantages of inflation is that, in fact, it discourages lending. It discourages lending. Smart banks need more interest to make up for the lost value. This prices some borrowers out of the market, making loans too expensive. Inflation also makes planning for the future more difficult, so businesses are less likely to take risks. No risk means no advancement, which stifles the entire economy. On a small scale, lenders are the losers from inflation and borrowers are the winner, but on the bigger scale, the beneficiaries, the government, and the overall economy is the biggest loser. Other losers are all those on fixed income and those who are priced out. Tim McMahon, I'm not familiar with him, but he says, my granddad lived through the hyperinflation in Weimar, Germany, to say he was an original gold bug would be an understatement. All right, so that was a pretty good article there. A big fan of that. Hold on just a second. And that's just basic economics right there. Inflation is the so what I want to do here, let's go to, because those all say, we're going to go to, so go to trading economics, flash PMI surveys. Oh yeah. By the way, we had jobless numbers that were pretty bad again. All right, so that's not good. I don't. Whoa, the Dow was down 354 the other day. Oof. You see, I don't even follow the market. Or is this futures? Are these futures, or is that what is that? I'm not sure, but they got. I don't know. I don't know. But anyway, what I'm saying is, at the end of the day, let's go to the job report was still pretty ugly. Not good, man. Not good. And look, I'm not going to blame Biden. I'm not going to blame Trump. Oh, actually, I do blame Trump. I'm telling you, should. All right, so let's go down to Japan, and I want to show you again. Here's Japan. Debt to GDP, right there. Debt to GDP. Jobless rate, only 2.9. Remember, 5% used to be, at least in America, full employment. 5%. Hey, boys. Hey, what's up, dogs? Yeah. And we're, 5% used to be full employment, and that would have meant high inflation was pending. And of course, that is just silly. Basic economics can all kiss my big fat behind. Anyway, so inflation in Japan. What does that say? Inflation rate in Japan. Negative interest rates, deflation. How can that possibly be, Josh? Well, and we're going to look at Japan, and we are going to say, let's see here, GDP annual growth rate, negative 1.4. But Josh, that's because of coronavirus. Well, is it? Let's take a look. We're going to go to prices. We're going to go to inflation rate. And, oh, look at that, deflation. How could that possibly be? Here's zero. Deflation, 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 deflation. Their highest inflation they got was in 2014 when it went to 4% for a short time, and then it went right back down to zero. So basically, they're flatlined, essentially. They've been flatlined since 2000. I mean, look at that. They have more deflation than inflation going back to 2000. Yeah, if we go to debt to GDP, where is we want prices? I always forget what we want. It's a government debt to GDP. And you can see the famous over 200%. They've been in 200% debt to GDP for, I mean, look at this, man. 200% right there since 2009. They've had 200% debt to GDP for the last 10 years. And it just keeps going up. And yet their inflation is nothing. Why is that, my friends? It's because no one wants to borrow. No one wants to lend. No one wants to spend. No one wants to consume. No one wants to take risk. So when I just, hold on a sec. And I'm going to hammer this till I'm blue in the face until someone has a reasoning for Japan. And I know I've heard the arguments a million times a Sunday. Well, Josh, they have an older economy. Josh, they only borrow from themselves. Josh, they don't have immigration. Josh, they're command control. The Japanese people are inherently geared towards command control. That gives me creeps when you say the Japanese, because of their ethnicity, they're inherent to command control. Yeah. And I don't like that. I mean, maybe there's some truth. I don't know. But what I'm just saying is, okay, but the arguments that if you have high debt to GDP, you have inherently inflation. Not happening in Japan. You have who borrows the most of the U.S. debt? It's the U.S. government. All right, so there goes that. Yes, we do have a little bit more immigration than Japan. That's a fact. How many of these people are actually coming in here and freaking being another Andrew Carnegie and stuff like that? Not that many. I mean, some come here and kick butt and take names. A lot of these people are not. A lot of them are digging ditches, which, hey, whatever. But let's stop this idea that we have this huge immigration that somehow is going to create some kind of inflationary component. And at the end of the day, we still have a shrinking demographics. I mean, it might not be shrinking to the extent Japan is or Europe, but it's certainly not growing by a very an Irish Catholic way of the 1900s. It ain't happening, if that makes sense. So, we can say all day long that maybe Japan isn't quite as entrepreneurial. Okay, I'll give you that. Maybe Japan has more of a top-down command control economy. I'll give you that. Maybe Japan has less immigration than we do. I'll give you that. So we might have a little bit of inflation. Right now, Japan has none. And they have debt to GDP over 250%, right around there. So, yeah. All right. Our country's not safe? Interesting. Japan has negative population growth. That's all they say. That's all they say, man. Negative population growth. Our population growth is basically flat. If you look at the projections for where we're going to be at the end of the century, it's basically flat. Japan's going to be way lower than we are, but it's going to be flat. China is only going to have 750 million by the end of the century. So that's negative population growth like you've ever seen. Interesting. So how do people, so we're all going to say is because Japan doesn't have immigration and we do, and our immigration is basically just keeping us above water. That's it. So look, these guys they love to say inflation's imminent. I'm thinking, explain Japan. And the only thing they do is they say Japan has negative population growth. That's all they say. That's all they got. They got nothing else other than Japan's not as entrepreneurial. Japan just listens to what they're told to do, and that's kind of racist. Japan, what else? What else? The other one they say, Japan, they don't have as much employment. They don't have as much. Then they borrow their own money. Well, that's what we do too. So I just sit there. No, Japan has. I mean, look at this. Japan Nikkei. If we go to, let's go to. Does he got the Nikkei on here? Hold on, just a second. I think he might. All right, let's see, my man. Oops. Oh wait, I guess stop that. All right, there we go. So we're gonna share my man Daniel Coolbert at 55e.co, 55e.co. I can't remember if he's got the Nikkei in here or not. Let's take a gander. Yeah, sweet, he does. Yes. All right. So what we're gonna do? Oh yeah. And you guys can buy this from him for like $25. 55e.co, Daniel Coolbert. All right. So what we're doing here is we got $100,000 in the K. All right. There we go. And we're gonna go back to 1990. If we invested $100,000 in the K in 1990, what would it be worth? I think we go to the end of 2019. He doesn't have 2020 up yet. Look at this, man. $100,000 invested in the K in 1990 is worth friggin' $60,000 today. Man, that is straight up ugly. $60,000. So that's without touching it. Now they've had some nice years. Look at that. 2012 to 2019, 2250. You know, they've had lots of black, one red, but they ain't getting the job done. Let's take some money out. Let's say you took, I gotta listen to Bill Bengen's 4% rule. Not that you would have done it back in 1990, but let's just try that for simplicity. I don't want anything here. Wait, let's see what happens. Yeah, I want that to be 0. Hold on just a second. Let's zero that out. There we go. Yeah. You took out 4%. You ran out of money in 1999. 10 years. Oh, man, that's freaking ugly. Let's do this in 2000. Let's see what we're looking at. If you did it in 2000, you ran out of money in 2012. Look at that. That's just 4% adjusted for inflation. And remember, we had deflation during those times, by and large. I mean, 4,000 by the end of 2011 was only $5,400. So not huge inflation by any stretch. Oh, wait, this is U.S. inflation. Never mind. Scratch that. That's on U.S. inflation. But either way, that's freaking, that's just ugly. Let's go back to 1980. That's nuts, man. So 1980, see, look at those black returns. Lots of black there. 100,000, took out 4,000 a year. Now just using U.S. inflation, I don't know how to, I guess I could, how do I do it? I want to not do inflation adjusted. How do I do that? We'll just do fixed. There we go. Yeah, sweet. So here you took 4,000 a year fixed. Because I don't know how to put the Japanese inflation numbers here. But anyway, so here you got 4,000 a year. starting in 1980 when the market started going gangbusters. And by the time 2009, we got to do, hold on a sec. We got to do 40 years. And we're not doing inflation adjustments either. So we're doing 4,000 a year, no adjustment for inflation. And by the time 2000, it looks like you still have money in 2019 if you only took 4,000 a year, not adjusted for inflation in Japan in 1980. That's good because those first 10 years were freaking kick butt and took names. But if you did in 2000 and 1990, your ship is sunk. What if you did in 1985? So you had 5 years of stellar market run. And then when did you run out of money here? Looks like you had $11,000 when all said and done. Let's see. No, you ran out of money in 2016. Oh man. Yeah, so that's Japan for you. That's not good. That's not what we want to see. That's for sure. So the question, Kurt, is Japan has not recovered. That's for sure. I told my Dean Witter broker I wanted to sell the Nikkei short in 1990. I was 21. He said I need to crawl before I could walk, and he was right. You would have made a lot of money. I think they say the Japanese react a certain way because of societal pressures, not because of their being Asian. Well, maybe. People are always afraid of more robots. That is, in my opinion, a mistaken idea. The current automation revolution is more similar to the industrial revolution than true destruction of the economy. Yeah. Did Japan get hammered because China's eating their lunch? Well, I don't think China was eating their lunch in 1990. Can we stop? We already talked about this. The U.S. is not a dangerous country. I don't. This whole thing that U.S. is dangerous is nuts, man. It's if you stay out of south side of Chicago, stay out of South Fulton County, you stay out of, I don't know if Anacostia, D.C. is still dangerous. When I was growing up around there, it was. I don't know. There's certain pockets of the United States that are dangerous. Stay away from those, and you're fine. I'm just telling you right now. It's just that simple. And sadly, the people who are stuck in those certain pockets, a lot of them want to escape, but they can't because of Obama and the left who got rid of school vouchers in D.C. in particular. Isn't it weird that Obama, Al Gore, all these clowns could send their kids to Sidwell Friends in D.C. where all the rich kids go, but poor black kids want to send their kids out of public schools in D.C. They couldn't. The first thing Obama did when he took office in 2009 was got rid of the school vouchers for Washington, D.C. The very first thing as a payoff to the teachers' unions. It's freaking evil crap, man. It's evil. But Josh, those vouchers, blah, blah, blah. Okay, well, you tell the moms of these kids that the vouchers aren't worth anything because they're lining up in freaking droves to send their kids out of the D.C. public schools. But no one cares. No one cares. I mean, Republicans care. Democrats don't care about black lives. Hell no. Not if there's no political power. The Democrats say, we will yield to the teachers' unions before we care about poor black kids who are stuck in these horrible public schools. Crazy. So Jim is big on cheap labor. Okay, I get you. I get it, buddy. You keep saying we need cheap labor. What do you think about consumer staples as an alternative to Vanguard, Wellesley, and the conservative part of the dumbbell strategy? Yeah, I mean, I'm going to call with that. Why even go down that road? Why not just say, just buy the Wellesley? Why focus specifically on a certain area? Let's see. All right, so that's a good segue to, I wanted to talk about, I had a guy sent me this right here. So let's talk about Wellesley versus, we're going to stop this, and we're going to go to, this guy had written an article that emailed me, Vanguard Wellesley versus Wellington. This is Young Research and Publishing, Inc. Dateline February 25th. All right. Now, as we sit here today, I had written a book on Wellington called Retire on Wellington. All right. I love Wellington. The reason I had written the book is it goes back to 1929. And as such, we saw the Great Depression. We saw the post-World War II. We saw the 60s and the 70s, the inflationary era. We saw the boom of the 80s and 90s. We saw the aughts. You see what I'm saying? So there's just a lot of data that we can work with. Now, how much that data will mean, it doesn't mean anything going forward because we have no idea, man. No idea. But it's interesting to look at. And if you're a data junkie like me, you're like, man, that data is pretty cool to look at. Wellesley doesn't go back that far. And that's the thing that's painful because what this proved to me when I wrote this book and I did the research on the book was that anything that is heavy in bonds got smoked in the 60s, 70s, and into the beginning of the 80s. It's just, anything did. You did not survive. You did not survive. Ironically, anything that was all in bonds did. Is weird, man. So I did a video on this where I looked at the Putnam, I think it was Putnam Income Fund, and that survived. So it was all in bonds. Wellington was, and I say heavy, it wasn't all stocks, it wasn't all bonds, it's 65-35, and it did not survive. It's an interesting dynamic that anything, when I say, I guess I should rephrase it, not anything that's heavy, I should rephrase it. I had thought, my presumption was that the bonds are what took Wellington and other investments down in the 70s, the late 60s and early 70s. Not necessarily true. It's not necessarily true. That was my thesis and my premise. And it still kind of is. Just we just don't have enough data for investments back then from the 60s and 70s during the inflationary time frame on bonds to see what survived or not. Anyway, the Putnam Fund did. It survived. And it's amazing to me because in deflation, we know stocks, they could do fine. They did in the 1870s all the way through basically the first decade of the 1900s, of the 20th century. During deflation, the Great Depression, the stocks got hammered. But basically at 40 years of stocks in deflation, they did fine. We have 10 years during the Great Depression of stocks in deflation, they got smoked. So you can't say deflation kills stocks. It's just, you can't make that. There's no correlation at all. Bonds, on the other hand, we know do great during deflation. All right, bonds kick butt, take names during deflation, and in my book I show you that compared to Japan. In fact, I want to see if I can't find it. I wonder if I can find it in my own spreadsheets. But anyway, if we look at Japan, I call it the. 1 second. Halftime. There we go. So Japanese bonds, 5% distribution, inflation adjusted, started in 1990, just using the Japanese equivalent of their 10-year bond. And you had money, and your money didn't run out until 2017. 27 years your money kept with Japanese bonds, and that's it, no more. And yet Japanese stocks, we were talking about the Nikkei, it ran out of money in 8 years at 5% inflation adjusted. And again, it was deflationary too. So I'm sitting there thinking, okay, so during deflation, bonds do fine. During inflation, bonds should do poorly. And yet the Putnam Income Fund in the United States did fantastic compared to Wellington. And so my thought process was that the bonds are what sank the Wellington. But that doesn't make sense because the Putnam Income Fund did fine. And what else got sank? The S&P 500, the stocks. So inflation destroyed your retirement plan if you had nothing but the S&P 500. It's like, whoa, I mean, that's nuts. That doesn't make any sense. And now the problem is Wellesley only goes back to 1973, so we don't have enough time to say, did Wellesley survive or not? I don't know. And no one knows. You can't make that. We just don't know. So it's all speculation. But we know two things for a fact. Wellington did not survive the 60s and 70s inflationary time. It did not. S&P 500 did not survive the 60s and 70s inflationary time, even though both have more stocks than bonds, and the S&P 500 has no bonds. They did not. That flies totally counter to what you think in inflationary times. The one example I could find with bonds, the Putnam Fund, it did survive. It's crazy. It's crazy. So I'm sitting there thinking, okay, the bonds survived. The stocks did not during inflation. What survived during deflation and what did not? Well, stocks is just like I always use the example, electrons. Electrons are bounce around the atom, bounce around the atom, bounce around the atom. You see what I'm saying? That's like stocks and deflation. They're going to, they go crazy like an electron. There's no correlation between deflation and stocks perform. You can't say because of deflation, stocks will do this. That only an idiot would say that. But with bonds, you can. With bonds, you absolutely can. You can say with deflation, bonds do fine because they do. And you're sitting there thinking it just inherently makes sense because a fixed income means deflation makes your fixed income more and more valuable each and every year. And so I'm sitting there thinking, okay, if I'm about to retire, right, and I'm saying there's two premises, there's three things that there's always going to be three things that can happen. The markets go up, the markets go down, the markets go sideways. All right. Based on a premise of inflation versus deflation. All right. So inherently you think well, inflation's got to come, right? I mean, it's got to. But why isn't it coming to Japan? I mean, we can argue with Richard Koo because, you know, the book, The Holy Grail Macroeconomics, which I freaking love. And I 100% subscribe to his theory on that. And I think it's here too. But anyway, at the end of the day, you can say, okay, so if inflation hits, what happens to our retirement portfolio? Well, you know, the stocks could go up or the stock, because we think stocks are hedged against inflation. Didn't happen in the 60s and 70s. Okay. So what does that mean? I don't know, but that's a speculation. All right. So if inflation goes up, we know that stocks may or may not last. The only area that we have any concern for that would be in the 60s and 70s, and stocks did not. We know that if deflation hits, and that's what Japan is, the stocks in Japan got smoked, but the bonds did fine. And that's where I just sit there and I think the Wellesley is a better alternative. And it's weird for me to say that, man. But the proof is in the, I hate to say proof because there's no proof. It's just, look, guys, and when I have no clue, you have no clue. This is just the things I'm thinking about because I do advise people. And I say, what is the biggest concern to a new or soon-to-be retiree? And the biggest concern, going back to Japan, is this flipping right here. Going back to 1990 in Japan. It's that right there. You can't survive that. You can't survive that. You're screwed. We can't have that, man. So what's more likely to give us that initially, the Wellington or the Wellesley? Well, the Wellington. Now, do I think the Wellington will be as bad as the Nikkei? No. Inherently, it should not be. But, you know, if we go to, we're going to go to Portfolio Visualizer. All right. And we're going to bring up that on the screen here. And Portfolio Visualizer. And I'm going to show you something, man. We're going to go to VWINX, that's Wellesley. And we're going to go to VWELX is Wellington. And we're going to say, what is the maximum drawdown? Maximum drawdown. 18.82 with Wellesley, 32.53 for Wellington. The maximum drawdown is from basically October 2007 to March of 2009. But you don't see that in the year-over-year stuff. All you see in the year-over-year is this right here. That's not, that misses a lot, man. In fact, you don't even see in 2020. Look at that, 2020, you don't see the quick bear market that transpired. So you miss a lot of the noise, which is good. But during that time frame, I see, this is where I just went back and did a video a few days ago, just saying, if you weren't advising people or you weren't retiring during these time frames from basically the aughts here through, you don't know how scary it can be, because you don't know this is the bottom of March 9th, 2009. You have no clue. And yet how many people got out and they missed this right here? Can't have that, man. It's ugly. So anyway, I look at Wellington, and Wellington, yeah, going back, and I see that 32.5%. And I'm like, dude, that's, and then if let's add S&P 500 just for oops. Oh, I gotta do it right here. Look at that, 51% of the drawdown. And yet, yeah, S&P 500 is down 37%, but it wasn't, that doesn't show you how bad it was. It doesn't. In fact, even if you go to the beginning of 2003, the first 3 months, the S&P 500 was down another 10%. Anyway, this is serious stuff, man. And, you know, there's no answer. That's the problem. Everyone wants an answer. There is none. You can't have those losses. And that's why I was talking the other day. I said, you know, this is where, you know, fixed index annuity or something like that might be a decent solution to make. And people say, when should I do it? Man, this is the problem. I don't know. I had a guy email me today, and, you know, he gave me this whole big, you know, hell, a 7-8 paragraph email with his, you know, presentations. I'm not going to read that crap. I don't have time for A, I don't have time. B, I'm not doing anything for free, because there's no upside for me at all to give a guy a guidance for free via email. I'd lose my license quicker than the friggin' Democrats would take my guns if that one arrived. There's no way I can do that. I'm not gonna. And anyway, the issue is, why would you want someone to do that? Retirement planning is no joke. It's serious stuff. You cannot go back to work once you're 60 years old and you quit your crappy old job in terms of the way you used to be. I'm talking with a guy, he and his wife are going to meet up again on Thursday. You make like $300,000-$400,000 between them. Was that the guy I talked to on Monday? Anyway, I talked to a lot of people, and you know, those guys I talked to on Monday. You know, they make great people. They make, you know, $300,000 or $400,000 a year between them, man. And they're going to go on mission trips. You know, they're late 50s or something like that. Just wonderful, wonderful people. And the issue is, if we screw this up, they're not getting that same job back, man. You see what I'm saying? And as such, you can't screw it up. Now, on the counter to that is, you can't just say, I can't. There's always going to be a risk. You see what I'm saying? And so, and they're well positioned to take the quote unquote risk because they got no debt. It all comes back to that. I had another guy today. I was going to do I did a video on it. And I think I sound like I was too churlish, and I don't want to come across like a dick. But I was like, and he said, "Hey, I got 300,000 a Roth. My wife's got 500,000 a traditional. I'm 56 and she's 54, something like that. Do you think we're okay?" And I'm just sitting there thinking, you know, I don't know. Why would I know if you're okay or not if I don't know the one thing? Again, I can't. You know, I just. It's frustrating to me in a way how many people email me, like, you know, I'm like, you realize that, you know, this is your retirement plan and you're looking for kind of like either a pat on the back or a guide from a guy you just watch on YouTube, which I appreciate, but I have no skin in the game. In fact, worst case scenario, not only do I not have any skin in the game, it actually is a net loss to me to take the time to think about this, simply because there's no benefit to me whatsoever. It's all negative to me, and there's no upside. And I say it's not just when people email me. When you email anybody and you want them to take time to evaluate your circumstance for free, and I'm not saying this is a way to make money. I don't, because I don't do hourly consultations anymore or anything. I don't want that. What I'm saying is, don't rely on some guy, you know, who's giving you free advice, because there's no skin in the game for him. And if he screwed it up, what are you going to sue him? And you say, yeah, how much you pay for that advice? Nothing. All right, well, you're on your own, right? And no financial advisors are going to give you advice. I mean, it's just not going to happen. Now, they might say you should buy an annuity. All right, well, they probably sell Anyway, and the reason I had to delete this video because I came across too churlish. Is that the right word? Curt. And I think it's churlish, actually. And I said, I don't want to sound like that, but like, dude, until you understand your expenditures, none of this other crap matters. And that stupid guy, Dan Gilbert, remember that guy from the bald head? For some reason, about 10 years ago, financial planning firms, they all loved older, white, bald guys with glasses. It's weird, man. They all wanted their own version of Dave Ramsey. USAA did that. Prudential did that. Other firms did that. Just older white guys with glasses. It's the weirdest thing. Bald white guys with glasses. I don't know where that came from. They all did it. I said USAA. We had a lady, I forgot her name, Julie or something like that. Some nice lady. And she was good. I liked her a lot, actually. And she died. She died from like breast cancer or something like that. Sad. Not that old either. Anyway, and then they replaced her with a nice guy. I liked him, but again, older guy, bald, glasses. And I said, dude, can anyone? It's like weird. Corporate America is like if one company does older white guy with glasses, another company will. It's the same thing. Or if they do, you'll see a lot of advertisements with like light skinned black ladies. Probably half black with real big puffy hair out. All of them do the same. It's weird. They all follow the same mode. Like, oh, that's the trend now. So it'll be like a light skinned black lady, not like but you know what I'm saying, not an afro, but like just big puffy hair. And it's like funny. I said they all follow the same thing. So it'll be an old white guy with glasses, bald. Okay, no, that's yesterday's news. Now it's gonna be, and what? Who knows what it'll be tomorrow? I don't know. But anyway, it's just it's funny. It's like, can anyone think for themselves in PR? Oh my goodness. Anyway, so this guy, Dan Gilbert, which would turn out to be a big far-left lib, not a very nice person, actually. So I don't know why be a dick, man? Anyway, so that's the whole point. It's like, I guess people can say, well, Josh, you're being a dick. I don't think so, but whatever. I represent myself. I don't represent the firm. And Dan Gilbert, I think it's his name, represented Prudential. Anyway, he had this thing called the number or whatever it was. Like, what's your number at Prudential? Blah, 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 blah. It's like, dude, what the hell, man? The number. The whole number is based on how much income you need. Until we figure out that, everything else is secondary. Anyway, so I'm starting to think, well, I want to read that article. That's what I wanted to do. So I'm sitting there thinking, maybe it's because, I don't know, maybe it's because I'm the version of a Japanese because I'm from Maine. Societal pressure being from Maine is that you make sure you prepare. Maybe that's it. You prepare for the worst and you pray for the best. You see what I'm saying? But you're prepared. I'm telling you, if you live in Maine or Michigan or the northern climb and you're not prepared for winter, something wrong with you, man. That's all there's to it. You've lived too good. You prepare because winter is coming and it's going to come bad and brutal and furious. And when it comes, if you don't have prep set up, you're going to be in a world of hurt. Maybe it's because I've lived on an island. I don't know, but I've always been a prepper, essentially. The point being is I look as retirement. I say, okay, what's the biggest risk? The biggest risk is not hyperinflation. And when I say hyper, I'm looking at 60s and 70s time frame. That's not the biggest risk. We're not going to have hyperinflation. I'm sorry, it's not happening. The only time there's hyperinflation is deliberately intentioned by the Kaiser or socialist economy. And why do we have hyperinflation? Because they regulate the hell out of businesses' ability to produce. Scarcity. What causes scarcity is government, socialism, fascism taking over and saying, you will do this or you will go out of business or go to jail. That's it. And as such, you create scarcity, and scarcity leads to hyperinflation. Every time it's tried, forever will be. Like the sun rises in the east, when socialism comes, hyperinflation comes behind it. Because scarcity of products. There is no supply, and yet the demand stays. And when the demand stays and the supply falls off the shelf, there's freaking inflation like you wouldn't believe. That's not going to happen, at least even with Sniffy Joe. I mean, obviously, falling down steps, he doesn't know who he is, but it's not. Kamal doesn't know what the hell she's doing. I mean, she's dumb as a rock. And so even Sniffy, before everyone says, you're just saying that because she's black. And is she black? I don't think so. But B, no, Sniffy Joe is dumb as a rock. Sniffy Joe is dumb as a rock before friggin' Kamala was even in diapers, by the way. The guy just not a bright guy. But he's a good politicker. I get it. He's good politics. I get it. But he's dumb as a rock. Anyway, the point being is they do have some evil cabal behind him, but they're not that stupid where they're going to bring socialism to America because they know that ruin their own ability to live in luxury. And as such, that's not going to happen. I mean, anything can happen. you. But I'm not all that worried about hyperinflation. The inflationary tendency of what happened in the 60s and 70s, yeah, I do worry about that some. I'm not going to lie to you. I'm also worried about deflation. Right now it's probably 50-50 how I look at things. It's deflationary or it's moderately high inflation of the type we saw in the 60s and 70s. But I don't know. But all I know is, okay, if either of these things happen, what's the biggest risk? Well, the biggest risk is going to be a stock decline. Like we saw in the aughts, like we saw in the Great Depression, like we saw in the freaking, basically from 66 to 82. I mean, just, you can't have that, man. We got to avoid that. So we got to play defense if you're about ready to retire. I did a video earlier today too. I said, okay, so I'm, let's just say I'm 50 years old, which I am. I'm 10 years. I got 10 years. I'm gonna plug money. So I'm not in any bonds because essentially my work is my bond, if that makes sense. All right, so I'm still making money until I'm banned from YouTube and you guys tell me I'll go to pound of sand, and then I'll have to go dig ditches. But as we sit here today, I'm making money, putting it away, paying off debt. So by 10 years from now, hopefully I'm paid up in terms of a retirement plan. And as such, I'm not going Wellesley. I'm not going Wellington. I got no bonds because bonds are not good during accumulation. They're just not, man. Bonds are good as a defensive mechanism. That's it. But as an accumulation perspective, no way, no how. Now, I did say it. I still think this too. I'm like, man, 10 years from now, what would you have wished you invested in today, 10 years from now? And I just got land on my head. I just think about an apple tree. What does an apple tree do? Well, it provides you a source of food, essentially. You see what I'm saying? It provides you a source of food. That is a fact. It provides you shade. If need be, it provides you firewood and things of that nature. And that's just a fact. The seeds of those apples provide you a source of seeds for future food. And I get it. An apple tree doesn't just sprout. I get all that. But what I'm saying is the glory of a piece of land where you can plant, and I just use an apple tree as a metaphor here, is that if you plant that sucker in today, you just took a branch, you plugged that sucker in the ground. Like I got a mulberry tree I plugged in the ground. It's probably 3 feet high. I mean, it looked dead, it had a little bit of roots. That's it. I put that sucker in 4 years ago. That sucker is big, man. It's the biggest tree in my backyard now. And it fruits. And some people don't like mulberries. Hey, I tell you like them if you're starving to death. You see what I'm saying? And that sucker's back, it grew like a weed now. It's huge. I have to prune it because it's getting so big. And I put some apple trees back. I got some plum tree back. And these things take a while. But until you plant them, you're not getting any plum trees or any a peach tree. I planted in the fall like you're supposed to. And I did not know if it's going to last. I did not know if it was going to last until I talked to a guy up in Michigan who's a peach farmer. I said, up in Michigan? He goes, yeah, man, there's certain types of peaches that are cold resistant. I said, damn. So I went to, I think I got it Lowe's for like freaking $5. I said, I'll put that sucker in the ground. It's freaking gorgeous right now. It's booming. Not booming. I mean, it's got all kinds of leaves on there. It survived the wintertime. It's a pretty cold winter we had here in Georgia too. I said, sweet. So that sucker's growing. My plum tree I thought was dead to rights 2 years ago. It gave me my first plum last year. That freaking tasted great. One of my best apple tree fell over because of wind, which sucks, but I'll replace that with something. And then I got a couple other apple trees. I relocated a fig tree, and I thought for sure I killed that puppy. That gives me all kinds of figs. But I don't have that big of a backyard, believe it or not. I just don't. And so as such, I'm kind of limited on what I can plant back there. And the old ball and chain, she likes a level grass field. And I'd like to have that sucker all garden, but she doesn't want this. I got a small little garden back there, but not much. But whatever. And I raise some, I do some hydroponics downstairs in the base and whatnot. But anyway, point being is, what would you want today, 10 years from now? You say, I wish I would have done this today. All right. And I think at the end of the day, it'd be something that would generate perennial fruits and perennial vegetables, fruits. You know what I'm saying? Obviously, when I say fruits, I mean, I'm talking all inclusive, but I got some blueberry trees back or blueberry bushes back there. They're growing. I don't get a huge, but I only got 3 of them. And I said, well, I'm going to go buy some more, plant some more in the ground. If I'm still here 10 years from now, I'll probably get an abundance of blueberries. That's the thing. So that's number one. All right. So a piece of land where you can plant something that will provide you a harvest for many, many years to come is number one. Number two, I think, would be gold and silver. All right, those things are good. I don't even want to say hedge against inflation because I don't believe that, but I do think they provide a store of value for future use for the calamities that may or may not come. So gold and silver, absolutely. Look, I'm not sold on Bitcoin. I'm just not. Not sold on it. Not sold on cryptocurrency. I'm just not. The more I hear people who say it's stupid not to be, the reason they say it is because look out you could have made if you would have invested. And when I hear that, it makes my skin curl. Like, okay, so invest in Bitcoin because look how much you would have made if you would have invested in it 5 years ago. I said, ew. I've heard that story 1,000 times a Sunday. That's not long. That doesn't convince me long term it's a good investment. Yeah, if you invest in it, look, do whatever the hell you want to do. I'm not touching a 10-foot pole. But anyway, I get it. People like it because it's done well, but I'm not touching it just because, I should invest in it because what it did in the past. Okay. Yeah, that sounds like that sounds ripe. Oof. Anyway, so I'm not touching that. So I'm not touching any crypto. I'm not touching any Bitcoin. But certainly gold and silver, trees, land of some sort for sure, paying off your house, paying off your debt. That's a big one right there. Plug in on a regular dollar cost averaging in the equity market still makes sense to me. But I think you got to expand beyond that for sure and start looking at other alternatives to where to put your assets. And again, not by taking on debt. Debt is the enemy, as always. But where can you reallocate things that you would? And this doesn't take a lot of money. I don't know the answer. Learn a skill. One of my wife's brothers used to cut meat. A big union guy, union thug, but he used to cut meat for a union up in Virginia. He didn't do that anymore. And I said, hey, ask him, does he miss? He goes, yeah, he does. He missed, because right now he's in a management job and he's not happy. Anyway, long story short, I was telling him, I said, man, you got to go to become a butcher, dude. I mean, and that's why I said in a video I did the other day, you have freaking work as far as the eye can see. You know what I'm saying? And you get control of your time and all that. Anyway, a skill like that, whatever it is, would be hugely beneficial as well. So going back to like Wellesley versus Wellington versus other things, is there a right or wrong answer? No, but I think if you kind of spread your knowledge base and start seeing things a little bit more so than just, stocks versus bonds, I think it'd be beneficial for sure. Now, again, if I just retired, all right, and I'm sitting on my house and I'm going to stay in, I'm also thinking about reverse mortgage, starting that line of credit on a reverse mortgage. If this is the house I'm going to stay in, I'm thinking about a way if markets fall or something like that, I can generate cash flow and a reverse mortgage line of credit, even if you don't tap into it. And ideally, you don't anyway until the future. That's something else because that puppy does grow. It does grow. As such, there's another thing that would at least give you some ability to not take from a falling knife, i.e. stock market decline. Because the one thing we got to avoid is we got to avoid drawing down money like what happened in Japan or in the aughts. We have got to avoid that, man. And so what are the alternatives to just stocks if you're about to retire to avoid that? Well, let's look at the Wellesley and we'll read this article. So these are just things I think about. It doesn't mean I'm right or wrong. I don't know. But I just sit there and I say, well, all right. For me, I'm still 100% market stocks, VTI or bust. But I'm not about to retire. You might be. So this guy wrote an article, pretty good article, February 25th, 2021, comparing Wellesley to Wellington. Are both balanced mutual funds managed by Wellington Management Company. They both invest in dividend-paying stocks as well as bonds, but there are some crucial differences, all right? Wellington was founded in 1929 as the nation's first balanced fund, so it's a long track record I like. Wellington was founded in 1970, 6 days before I was born. So if you buy the Wellesley, you're buying 6 days for your old buddy Josh was born. There aren't many balanced funds or mutual funds in general that have survived for over 50 years. I don't know about that. Let's see. Wellington is sometimes referred to as the blue blazer of Vanguard mutual funds. That's a compliment. Not sexy, but reliable. It aims for long-term capital appreciation and some current income, invests approximately 60 to 70% in blue chip boring stocks and 30 to 40% in government and corporate bonds. Has a mandate to generate income, dividends for investors, is popular among retirees, just like the Wellesley. All right. Let's see. They buy a mix of dividend stocks and investment grade bonds. Wellesley targets 60 to 65% in bonds and 30 to 40% in stocks, whereas Wellington is the mirror image. The benefits of a balanced portfolio. So they kind of give us the S&P going back to 1973, the down market in 73. Here's the S&P 500. Here's Wellington. Here's Wellesley. S&P, Wellington, Wellesley. 77, Wellesley. 81, Wellesley. 1990, Wellesley. 2000, Wellesley. But Wellington still only had one down year. That was in 2002. So Wellington survived the first 2 years of this century quite nicely. 2008, we talked about there's S&P, Wellington, Wellesley, and then 2018. So you can see the Wellesley had a lot less downside risk. And when you retired, we got to watch that downside. Wellesley is also more consistent performer than Wellington. Since its first year in operation, has generated annual declines only on 7 occasions. That's an 857 batting average. And with the exception of 1973, every year following an annual decline, Wellesley has been up by double digits. All right, so exception of this right here, Wellesley has returned in the positive in double digits whenever it had a decline, because the bonds typically have done that. Let's see, and here's the difference between Wellesley stocks have a higher dividend yield. All right, that in of itself, don't get too caught up in dividend yields. I'm telling you, man, you got to be careful there. Dividend yield does not mean a better buy. Y'all can see it. Okay, sweet. It's going to be hard to see, but here's Wellesley, J&J, JP Morgan, Cisco, Comcast, Bank of America, Pfizer, Procter & Gamble, Medtronic, Caterpillar, and Philip Morris. Microsoft, Google, Apple, Facebook, McDonald's, JP Morgan is the only thing they have in common, and Procter & Gamble. So the Wellington and Wellesley, the top 10 stocks, are a little bit different in terms of the holdings, if that makes sense. And this is as of, I'm not sure when it was as of. Sector breakdown, Wellesley has a lot of healthcare, financials, the same thing here, financials, healthcare, energy, consumer staples, and tech. So basically 3 of the top 5 sectors they both have in common. The bonds of the Wellesley and Wellington are more similar than the stocks. They invest in intermediate investment grade bonds. Okay. Each fund has over 1,000 bonds. Yep. And the portfolios have an average yield to maturity of 2.6. Which is good. An average duration of 7.4 years. Credit quality is another big factor. The credit quality are about similar. AA, so basically highly rated bonds. So Wellington has 111 billion of assets. Wellesley has about half that. In fact, Vanguard's Wellington is the 3rd largest balanced fund in the U.S. and the 6th largest fund, including all actively managed stock and bonds funds. That's crazy. For many years, we advised Vanguard, Wellesley, and Wellington, but today we view a portfolio of individual stocks and bonds as a better option. I do not agree with that at all. Wellington and Wellesley's bloated size, along with the bond portfolio that has a relatively long and flexible duration, today's historically low interest rate environment, and a stock portfolio focused on mostly U.S. firms makes them less appealing. I don't agree with that at all. All right. Choosing between Wellington and Wellesley comes down to which asset allocation is more likely for you. I disagree with their assessment that because you should be in individual stocks and bonds. I don't agree with that at all. So anyway, if I am a more conservative investor, I'm adding to my portfolio, I would go Wellington. If I'm a near-term retiree, recently retired, I'm going Wellesley. Just is literally that simple. Each individual case is different. When I talk to clients, it all depends on their needs. Do I still like the barbell? 100%. 100%. The barbell consists of 4 years of cash and VTI. It's literally that simple. What I like about the Wellesley and the Wellington is it's the bucket strategy with kind of like a barbell approach. Now, people say, if I have Wellington or Wellesley, do I have 4 years of cash? No, you don't need 4 years of cash there. That'd be a little bit overkill, especially with Wellesley, because Wellesley is so heavy in bonds anyway. But what I like about those two funds is that you have some cash, and when I say it depends on how much what we're looking here, but you don't want 4 years of cash if you have the Wellesley. That doesn't make sense, all right? Because the Wellesley essentially is giving you a significant bond exposure, so you don't want to just be redundant with lots of cash that doesn't have any upside. So basically a year, maybe 18 months of cash, the Wellesley. It's a freaking wonderful approach, man. So you got enough cash to pay the bills. The Wellesley shouldn't take on the chin any significance by any stretch of the imagination. So as long as you have enough to last you a year without having to pull money out, you should be fine, Wellesley. Wellington, 2 to 3 years cash. You got 2 to 3 years cash in Wellington, 35% in bonds, and 65% stocks. That's going to be roughly a 50-50 portfolio of stocks to bonds and cash. It's pretty good, man. It's going to be tough to beat either of those. So you got stocks, bonds, cash, the bucket approach. Wellesley, bonds, stocks, cash, the bucket approach. The easy one, in my opinion, is VTI with 4 years cash. I might want to think about increasing that to 5 years cash right now. The market is, I sit there and I say, I sit there in awe, frankly, about where we've come from a year ago. It's nuts. But actually, yeah, today's what, March 20th. So March 23rd, I think, is when we hit bottom last year. Yeah, so we're basically a year into one of the biggest bear or bull markets we've had. It's nuts. Think about that. A year ago, people were pooping bricks, you know what I'm saying? And now we fast forward a year later. I mean, let me just see real quick. This is just without dividends. So let's look at VTI. That's always my proxy, VTI. VTI is at 205. So last March 23rd is at 126. 126 on March 23rd. Now it's at 205. So if I take my trusty calculator, I say 206 minus 125 divided by 125. It's up 65% in a year's time. That, my friends, is flipping nuts. That's nuts. All right, so VTI in 2000, that's without dividends. In 2017, VTI was starting the beginning of 2017. 117. Now it's at, yeah, so basically VTI without dividends has gone up 100, it's gone up 100% since 2017. At the end of 2018, VTI was at 123. I mean, so you that's not even adding to your shares by reinvesting dividends. At the end, I mean, it was at 103 in 2016. It's doubled. Not just, I mean, I mean, that doesn't happen it does not happen like this on a regular routine basis. It doesn't. I'm just telling you, man, protect the downside. Protect your gains and freaking lock away for the feast and famine, the 7 fat years and the 7 famine years, man. This doesn't, I mean, look at this graph. What is that based on? Biden? Hell no, man. I don't get it. I don't get it. So if that doesn't concern you, or this huge run we've had, I don't know what to tell you. And look, hopefully it doesn't fall. Hopefully, QE forever will keep the markets high. Because what QE did is it inflated assets. I mean, come on. It didn't inflate the currency, but certainly, or inflated, devalue it, but certainly inflated assets, real estate, stocks, and bonds. It did just that perfectly. I don't quite think that's what all they were hoping to inflate, but for those 3 things, for the people who had the money, they freaking made out like a bandit, man. I was reading some stock the other day. I was like, damn, who was it? Can't remember. I was like, that guy got rich over the last, I forgot who it was. No, I forgot. But I was like, damn, dude, it's nuts how much these guys, like Amazon, Bezos, whatnot. It's nuts how much these guys are making. It's amazing to me how much money these guys got. Amazon, I mean, just look at this. That is, I mean, are they killing all the other competitors where they're going to have a monopolistic? Yeah. All right. So what happens when these companies get monopolistic powers? What happens to them? They get regulated. They don't get shut down. They get regulated, or they got to be broken up. Regulated like utility. What happens to a utility stock? There's no growth there, man. It just pays a nice dividend, but that's it. That's it. Nothing wrong with that. But there's no growth. You're not getting growth in central main power. It's even central. My mom used to tell me that was one of the first, I think that might have been the first stock I ever owned, central main power. I don't even know if it's still out there. Is Jeremy still on here? What's central main power, man? I don't even know what who it got bought. I'm sure they were bought out by somebody, but central main power is now somebody else, not central main power anymore. Anyway, so whatever happens with these companies, they get so big, they get regulated, become utilities, and they give you a dividend, but there's not much growth. All right. Yeah, right. 100%. Everyone made money in the market the past year. How much longer can it go? Man, I don't know. All right, so let's look at some other things here, because that, yeah, around 100%. I think you got to build cash, man. Build cash. Can I just say real quick too? He'll go nameless, but let's do when I was driving back from Auburn, a live stream. A guy said, he said, I was buying this, I was buying that. I said, what were you buying it with, dude? I didn't say that. I just wondered, like, what? I'm buying all the dips with what? What are you buying? I mean, with what cash? I mean, did you just make $100,000 one day and now you're going to put that into market? Like, I've always wondered, these people say I buy on the dips. With what? I got no cash to buy on the dips. I mean, I got enough to pay my bills. That's it. But that's not money that's going in the market. That always confounded me. Like, how do you buy on the dips? It inherently says you're not fully invested. And if you're not fully invested, that's a rookie mistake. Because we know if you miss going back 20 years, you can do any time frame. If you miss like 10 of the best trading days, your market returns are just, they're nothing. You have to be in the market to gain the market. Yeah, I mean, literally every day, which means downs and ups and downs and ups. So if you're buying on the dips, that means you had a boatload of cash on the side and it'll allow you to buy on the dips, which meant you missed the rises. The weirdest thing. So whenever you hear people call them out, say, I buy on the dips. Oh, yeah, no. I had a guy, he posted on my YouTube channel the other day, and I said, yeah, okay. It's kind of like when they always say, I've always voted Republican, but until Mitt Romney came along, I'm voting for the Democrats. I've always voted Republican until John McCain came along. I'm voting for the Democrats. It's the same. Rush Limbaugh used to call them seminar callers because it's the same thing. I'm conservative. I voted for Reagan, but now Donald Trump is taking it too far. Like, yeah, whatever. Just come on, man. I've heard these stories. Look, only a rookie thinks that's true. Like, oh my goodness, we're driving away our Republicans. And that might have worked back in the old days. It should not work now. It probably does because the Republican Party is idiots. Anyway, when I'm sitting there thinking, this guy said, he goes, I bought all in 2009, and I made up, 300% of my money, whatever it is. I said, oh, okay, so you were out of the market in 2007? Well, yeah, exactly. No, I was in a different stocks. It's okay, so I got you. No one's impressed. I went all in the S&P 500 2009. I said, well, what were you before that? You weren't in the market? Well, yeah, okay. Because everything went down except for government bonds. So if you were not in government bonds and you were in the market, you got killed in 2007, 8, and into 2009 as well. If you went in all in the S&P 500, that's fine, but that's not impressive because everything was on the bottom in 2009. Everything other than government bonds. I hear that stuff all the time. Why is that? And so it just, do people think that people are being pressed like, I buy on the dips? Yeah, with what cash? What cash did you buy on the dips? When was a dip actually? Because you ever heard of a dead cat bounce? You might have a dip. A cat gets dropped off the Empire State Building. He hits the ground. He dies, but he bounces because the momentum bounces and then he falls back. Dead cat bounce. So buying on the dips, you could be buying a dead cat bounce, could you not? Or right before a dead cat bounce and then it falls again. I mean, who knows? I don't know why people have this incessant desire to say, look at me, I did. I'm like, who gives a crap, man? I could care less what you did. Let's just be realistic and say, yeah, I was out of the market in 2009. I got out of the market because I couldn't take a 54% decline. So I got out and I've missed it ever since. That takes guts to admit that. It's silly to say I buy on the dips because that inherently tells me you're in cash, which means you missed out on a significant run. To buy on the dips means you missed out. Here's the S&P 500 on a lot of that right there. That means you had cash on the side that was waiting for the dips, that's doing nothing for you. And you can't, if you're going to be investing, don't do that, because that's not investing. That's speculating. Anyway, you build up cash. Going back to what I said, like my man James said there. You build up cash to, yes, have some dry powder, I grant you, but not even that so much, is to give you a place to spend your money if things go south. I'm telling you right now, man, that's even while you're working, by the way. I'm a hypocrite. I got no cash. If I needed, if YouTube banned me and you all turned through Rotten Tomatoes at me, I'd have to spend down some of my stocks, which sucks. But that's a risk I'm willing to take for sure. So I'd have to sell and spend them down. Stock market is down 50%. I'm going to be in the world of hurt, but I know what I need to survive a year, if that makes sense. So if market's down 50%, I got no income coming in. Everyone hates us because I won't be vaxxed, and everyone says, "You're not vaxxed. You stay away, Josh. You can't even talk to you on YouTube because you might give us the virus because you're not vaxxed." I'm like, "Well, I thought you were vaxxed." "Well, we are. So how are you going to get the virus?" "Oh, but anyway, so I'm not vaxxed." They're going to say, oh, stay away. I hate you. And look, I don't care if you get vaccinated. It doesn't matter to me. I really don't care. I do care when people say you have to do it or else you're risking other people's. Anyway, long story short, what I'm saying is, let's just say I have no money coming in. I'm ostracized. I'm a leper. I said, okay, I'm going to sell my stocks to pay the mortgage, and my stocks are down 50%. That'll give me more than a year's coverage, if that makes sense. And that's the worst case scenario. And I got a good amount of equity in this house, which we could downsize. I'm not afraid to dig ditches. You know what I'm saying? I'm not afraid to put a hazmat suit to go and to greet people at Walmart. If I have to, I'll put the damn hazmat suit on. If they force me to take a freaking vax, no, I won't do that. So whatever, man. You know what I'm saying? It is what it is. I guess that's a nice thing. When you grew up poor, you don't want to go back to poor, but you're like, if we survive, we'll do it again. All right, so let's read this right here. How to survive which one was it? Actually, hold on a sec. All right, right here. Now look, I am not negative on the market. I'm negative in the regard that I think there are some growing risks, like this article will tell us here. But I am 100% in the market. I just want to be clear there. I am not out of the market, biding my time, waiting to buy on the dips. I got no cash. Everything is in VTI, VTV, VTI, VDIGX. I'm actually going to buy another stock. I am going to buy another stock on Monday, and I'll share that with you here in just a second. It's one of those, I got 100 shares of Exxon. All right. Risks are growing for this historic stock market, how to protect against a plunge. And I'll probably do another video on this alone later on. But record highs, record angst. Now, look, record highs is not a risk. Can we, for the love of the good almighty Lord, there's always record highs. I don't understand why people, oh my goodness, the market's at a record high. Tell me when it wasn't. It's always at record highs because the market has gone like this. Such is the predicament of many investors as the stock market keeps rising higher and higher. The historic advance has left many investment accounts plump with unrealized gains. And that's starting to make some investors fret about what comes next. Tesla and electric vehicles and Bitcoin will save us. Does a good thing go on forever? Human nature and experience suggest otherwise. Though it's been hard to be bearish about stocks for a long time, it hasn't been hard to be bearish about stocks. That's a false statement. That's silly. People have been bearish about stocks for a long time, and they've been wrong. Some investors are beginning to fixate on the unrealized gains in their ports. Rather than selling securities to lock in those gains, which is a profoundly difficult decision for all but the most disciplined, investors are looking to protecting them with options. It's impossible to quantify hedging activity, but defensive trading patterns are starting to emerge in the market. For the first time in ages, says this guy, Schwartz, the dean of the Street's option strategies, clients have begun asking how to hedge stock positions in case something upsets the market rally. If he talks about Black Scholes, you're going to see right now, I'm going to commit YouTube. I'll be the first on YouTube. I'm going to take an anvil. I'm going to drop it on my head for all to see. Please don't talk about Black Scholes. His clients aren't citing specific reason for stock market decline. He just says they seem to be concerned about making money through investing won't be as easy. The S&P 500 is up 78% since March 2020 lows. To hedge, Schwartz has advised some clients to buy put options directly on the S&P 500. A $1 million portfolio correlated S&P 500 can be partially hedged against a 10% stock market decline by buying 3 S&P April 3900 puts. Each contract costs about $6,600. When the benchmark, the total cost to hedge is about $20,000. But how much are you hedging? If the index declines by 10%, the portfolio declines by 1.24. And don't hedge against a 10% decline. That's freaking stupid. All right. If the index is above, okay. During the last 52 weeks, the S&P 500 has ranged from 2,100 to 4,000. It's up so far 4.2% this year. Dude, don't waste time hedging on a freaking 10% decline. That's dumb. Over the years, we have rarely discussed hedging strategies. Our preferred option since the 2007 crisis has generally been to sell puts and buy calls. The existence of a massive Fed put minted by low interest rates has generally supported such a bullish posture. Ironically, this has helped make hedging more reasonably priced for the first time in a long while. All right, so he's talking about buying puts in right here, and Steve Sears is the Chief Operating Officer of Option Solutions. So if you want to learn more about options, talk to Steve Sears. That's great. Good stuff. So because he will sell you option strategies. You don't hedge against a 10% decline. You hedge against a catastrophe. It's like using insurance. What healthcare is insanely expensive. Oh my goodness. I had to get an anal swab to see if I had friggin' COVID. I'm going to send a bill to my insurance company. You don't do that, dude. You don't send a bill to get an oil change to your insurance company. Why are you going to insurance to get a freaking nosebleed fixed? Pay for it out of pocket. Ugh. You don't hedge against a 10% decline in the market. That's freaking stupid. You hedge against a 35% decline, 40% decline. 10% of the market happens every year. If you look at JP Morgan, they do a study every year. The average market decline, top to bottom, throughout the year is 14%, 14.4, the last I read. So in any given year, you should expect, we'll just say, a 14% decline within the market that year. Hedging, why would you do that? Stupid. Don't waste the time or the energy. If you're going to hedge, you hedge long-term, buy put options for leaps. You say, I'm making sure I don't get killed 35%. I get that. The other stuff, no. And that's where you look at my man Amar Shaw. Say he can hedge. I don't know the first thing about hedging. I know about options, selling calls and covered calls. That's easy. And I'll never do that again because I got smoked. I mean, selling covered calls is a risk mitigation strategy. It works like a charm unless you do like I did. Keep selling calls against a stock that's going down in value. Dumb. The worst investor ever right here. But anyway, so if you're looking for hedging, get some guy who knows what he's doing. My man Amar is a CFA and a CFP. Ain't too many of those people running around, that's for sure. And he can hedge for you, but that's not me. And he certainly shouldn't be listening, some guy on YouTube on how to hedge and I'm going to learn option strategies. No, get some guy to do it for you, and then you can learn from him. But you're going to pay him. That's the thing. Pay somebody for his expertise, and then you can do it yourself. All right, so we read that. I'm not a fan of that article. So someone had sent me this HND. Oh, you guys can see the whole second. A high. ETF designed for retirees. Oh boy. A high income ETF designed for retirees. HNDL handle. All right. Don't know the first thing about it. Let's see here. So this is written by Nathan Reif. Nathan Reif has been writing expert articles and news about financial topics. All right. So let's see. Among other options, retirees can opt to set up annuities to receive a steady income. All right. While annuities are generally considered to be risk-free forms of investments, I don't know about that. They do have disadvantages. They're seen as largely illiquid because they are, and they're only as strong as the insurance company. Yeah, I agree with that. There are 79 million baby boomers, and thousands of them retire each day. There are now more than ever for additional options to ensure that these individuals continue to have regular money for living expenses. A new exchange-traded fund has been created for this demographic, oh boy, and presents itself as an alternative to annuities that aims to offer a steady 7% annual distribution rate to investors. Okay. Cash flows paid to investors are distributions, not dividends. Return of principal, I get that. Well, we can generate 7% return on principal simple. So we take $100,000 and we give ourselves $7,000 a year, divide by 7,000. That'll be around for 14.28 years without any interest. So you add a little bit of interest, it'll be around for 17 years. Not that difficult to do that, but let's take a look. The ETF launched in January 2018. It's called the Strategy Shares NASDAQ 7 handle. When was this written, by the way? Just the other day. All right. It claims to be the first ETF to pay investors a consistent monthly distribution. We don't want consistent. We want rising distributions. By and large, but let's keep going into this. What's more, the distribution aims to be 7% of the fund's asset value at the end of each year. It's a huge offer. The portfolio manager, David Miller, he explains what's unique about this as opposed to just owning a diversified portfolio. Investors won't have to go to the effort to sell part of their holdings to generate what they would have got from distributions. It's pretty expensive. There's another product is something, okay. It has a high expense ratio, 1.17. Okay. On the other hand, the First Trust, which is Brian Westbury's group, aims for a yield of 6.7. Well, this isn't a yield. This is a distribution percentage. A distribution percentage and the yield are two completely different things. So is First Trust aiming for a 6.7% yield? The distribution is not a dividend, but rather consistent payout that's reliable. Managed income account sounds like. Near another sum of all of the distribution may consist of return of capital, meaning that if necessary, the distribution can be funded by capital investors that paid in. It will be, at least some of it. So, oh boy, it acts as a fund of funds holding other ETFs. So that's why it's so doggone expensive. Tracking two indices and a 50-50 ratio, is using a Dorsey Wright Explorer portfolio. So Dorsey Wright, I've always found them interesting. I don't subscribe to their theories out of Richmond, Virginia, but I've always been a fan of Dorsey Wright analytics. It's interesting if you like that stuff, which frankly, I don't like that much, but it's interesting to read the Dorsey Wright group of people down there in Richmond. They used to be in Richmond. I imagine they still are. The first season offers long-term exposure to U.S. equity and fixed-income markets. It holds the decay, tactical allocation index. Okay, so managers of the fund use leverage. About 23% of the portfolio as a means of boosting returns. So leverage, high distribution, and liquid solutions. All right, so all right, that doesn't impress me at all. Sorry. I mean, leverage works until it doesn't, man. It works until it doesn't. I'm not that impressed by that in the least. That's no. If you want a 7% distribution yield, you got it right there with the good old fashioned cash. Now, literally, that'll give you, basically 15 years. You throw a 3%, buy a long-term bond, a long-term government bond, paying roughly 2.5%, 3%. There's going to be probably run you 16, 17 years. Nothing wrong with that. All right, so let's see what else. Yeah, exactly. 17 million Americans unemployed, not inflationary. That's right. Even long-term investors take a small flyer. I agree with that. Yeah, so life insurance cash value is part of the bond portfolio. I wouldn't call it like a cash because you can't write checks against it. But yeah, I agree with that. The issue is that remember the life insurance. If you screw it up, man, that could be a big tax hit later on. Just keep that in the back of your mind. And a lot of these. I had meltdowns on YouTube because of the COVID market crash. I did? I had meltdowns because of the COVID market crash? No, I was telling people to do Roth conversions. What are you talking about, man? I had meltdowns because of the market crash? No, I didn't. I said, now you got to be freaking converting. And I told people that in February of last year and March last year. So I don't know. I don't know what to talk about, brother. Yeah. Some bond funds are down. It's 100%. Cash bucket bonds the same. Nope. But I like Ginnie Mae. I've said that a million times a Sunday. Ginnie Mae, VFIIX. Actually, let's see what Ginnie Mae has done so far this year. And we're going to go to Market Watch. And we're going to see what, let's go here. We're going to share the screen. All right, so let's see what old Ginnie Mae has done so far this year. VFIIX. I have no idea. Let's see the year to date. Oh, yeah, down less than 1%. So Ginnie Mae is down less than 1%. That's what I'm talking about. So I just love this. I love it. I love it. I love it. If I wasn't married if I didn't punch up with my wife and married a better woman than I am as a man, I would marry Ginnie Mae or whoever runs the Ginnie Mae fund. I'd give him a big hug. And even if he's a dude, I'd say, hey, I'll swing that direction because I'm willing to for Ginnie Mae. All right, so let's see. So that's good. So let's look at is it BBLTX? BB. What's a Vanguard long-term corporate? I saw it right there. Long-term. Oh, sorry. VGLT. Let's see what this guy's about here. Does it give us year to date on ETFs? I can't remember. I don't think it does. I think it just gives us on mutual funds. Why does it give a year to date on ETFs on here, man? All right, so let's go to mutual fund. What the fund? What the fund? Right there. It's got to be down pretty good, right? Let's take a gander. Let's gander, shall we? Yeah, look at that, 14% right there. That's not good. That's not good. I don't like to see that at all. All right, let's look at intermediate. Let's look at total internet. I don't want international. Total bond index. I don't want the international bond index. Total bond. Yeah. There we go. All right. So remember, the bond index is 70% government bonds, roughly. Mortgage, Ginnie Mae's, mortgage-backed securities, Fannies, I imagine, and treasuries for the most part, and 30% some of the most heavily indebted corporate American companies out there. So just keep that in mind. This guy's got to be down pretty. Only down 4%. That ain't bad, man. So I mean, that's the thing. It's like you're 4%. That's nothing. It's the long-term bonds that got smoked, and that makes sense. Actually, let's go back. I want to show you guys something real quick. Let's go back to I'll tell you what. Let's Vanguard long-term. I want to show you guys something how you can long-term corporate bond. Okay, so let's just. I don't know if the ETF will show us what I'm looking for. No, that's not what I'm looking for. All right, let's go back to mutual funds. Probably should have gone to Schwab's website, kicks butt. All right, let's go to the mutual fund right here. All right, so remember, this guy's down 14.5% so far this year. And what we're looking at is we're going to look at, I hope it's on here. I'm looking for duration, distribution. I don't see it here. What's duration, man? How do they not have duration on here? All right. The Market Watch, what the hell, dude? You don't have duration? All right. Well, anyway, duration is just a measurement of the downside risk of a bond fund if the interest rates go up 1%. Everyone says it could go down too, but no one cares if it goes down because that means the price is going up. So if you have a duration of 5 and the interest rates go up 1%, the price per share will drop by 5%. That's what duration means. If you have a duration of 5 and interest rates go up by 2%, the price per share will drop by 10%. And I can guarantee that long-term bond has a high duration, probably like a 15 or something like that. It didn't show it there, and I don't feel like looking that much for it, but that's what duration means. So if you're looking for risk in the short term, the price volatility of a bond is always going to be found in duration. That's how you measure that. Again, that's under the assumption that interest rates jump up a full percentage point, and that it doesn't happen that often. It just doesn't. My friend who's an oil trader likes Valero and Exxon. Yeah, right on. Time to buy oil was 8 months ago. No, man. Small caps are up almost 20% for the year. All right. Yeah, 100%. No one cares about day trade. Yeah, this is not a day trading channel. I'm telling you right now. It's I listen to some of these guys on day trading. It bores the living hell out of me. I'm like, dude, oh. I'm like, really? We're day trade. I mean, oh man. Whole life insurance premiums increase as you age, then it costs too much. No, that's not for whole life. The point about whole life is level, Kim. So whole life, you're literally paying a set premium for your whole life. Whole life insurance premiums should not increase as you age. If they increase as you age, you got something wrong with your whole life insurance policy. Just keep that in mind. So if I may, remember the difference between whole life and universal life is huge. Don't throw all things under whole life. It's actually permanent life insurance where universal life and whole life fall under. So a lot of people make the mistake, and I think that might be what our friend Kim's doing here. They're taking whole life as the entirety of permanent life. Now, that's simply not the case. Whole life and universal life fall under the permanent life insurance branch, if you will. So you got permanent, and then you got term or temporary, if you will. Permanent and term. Under permanent are whole and universal, and then term is term. So just keep that in mind, and not picking on you, Kim, but that's a mistake a lot of people make. I say, what kind of life? Oh, I got whole life. I said, okay. So when, as a financial advisor, I hear whole life. I hear set premiums for your whole life, which may or may not be but that's different than universal life, because exactly, as Kim meant, universal life. Exactly. Now the dogs are upstairs with my better half, and they're sleeping on the bed with her, and she had to get up early, like I normally have to do, to take care of her when I was gone. It's funny. And she's like, man, the dogs woke me up at 5 o'clock. I was like, welcome to my world, sister. Welcome to my world. Oh, man. Vanguard long-term treasury has a 18. You can see I'm getting tired. As an 18 duration, right on. All right, so James, put you on the spot. 18 duration. Interest rates go up 2%. James Palace. What happens to the price of the bonds? Huh? James Palace. Smarty, farty. So we got a duration of 18. Interest rates go up 18%. There's a 15-second decline, so I'll let him. All right, so Yeah, life insurance is not an investment, my friends. You don't invest in life insurance. I cannot stress this enough. Life insurance is not an investment. CDs are not an investment. Okay, there's similarities to things. These are not investments. I cannot stress this enough. I disagree. What? Yes. I saw this with James, the dude. But then he said, oop, he fat fingered. He meant to say 36. Ding, ding, ding. James wins. James, you want a copy of Ludwig von Mises, The Theory of Money and Credit? If you do, send me your address, email me your address, and I'll send it to you. I cannot tell you when I went to the Mises Institute. It was, oh my goodness, man. It was the best thing ever. You go there and you see these books. You see Karl Menger's book in German, his original book he published in the 1800s. On top of that, had a lady. Oh, I got to show you guys this. Oh my goodness. Here's the real world we're living in, my friends. So can we stop this crap that we're going to freaking... You're not going to live on a solar photovoltaic. You're not going to just stop the crap on, fantasy land stuff. Let's look in reality. Stop the crap like, they're not going to ban things. Check this. I want to share this right here with you. There are threats out there. All right. And it's not good. And it is going to get ugly because right now there's a certain group of people, the left, who are on the march. And if we don't stop them from marching, we're going to live like this person here, whose name's Ekaterina, I guess, because she's from the USSR. One more suggestion, if I may. Keep your collection somewhere very private. People will turn to volunteer snitches very quick. Back in my former country of the USSR, people went to prison for reading banned books. My family had a Bible that was copied on an underground copier. These reproduction machines were also banned. Mom kept it in her underwear drawer. We were forbidden to tell anyone about it. And by the way, perfect method to make kids read something is to forbid them. Exactly. Mom also hid in the same place this other guy, and I didn't know who this guy was. That's his pen name. He's got another name. Off the top of my head, I can't remember what his name was. But apparently this guy is the father of the short story from France. And copied Godfather books. Granted, we read them in the Bible with the same interest. Here is a lady. See, this is history right here. She's living it. You think it can't happen here? You freaking crazy? Hell, the Dr. Seuss stuff, whatever, man. Dr. Seuss Foundation, they're stupid, but they have a right to say we don't want that out there. It's dumb, but whatever. That's not the thing that concerns me. The thing that concerns me is hold on just a second. The thing that concerns me is we're going to go to Amazon. All right, hold on just a second. And we're going to go here. And we're going to try to find Winter in Moscow by Malcolm Muggeridge. And we're going to click on it. And if you're not familiar with Malcolm Muggeridge, you're wrong. Why? There's no Kindle. There might not be a Kindle. I get it. It's an old book. Look at that. Why are anyone producing this? Out of print, limited availability. Does that make any sense? Why would someone not? Now, I don't know. Has Jeff Bezos banned it? I don't know. Could they? Yeah, because he says apparently some disparaging things about a certain group of people that cannot be disparaged. And I've never read it. I don't know what that group of people is. I don't know. I haven't read it. I have a pretty safe assumption what it is, but either way, the 1934 fictionalized account of Stalin's Moscow presents an Orwellian nightmare satirized as Western journalists blithely overlook starving peasants and support the utopian claims of one of the bloodiest regimes in history. It's got 16 ratings, 4.5 on average. Why someone would not write this, I don't know. It's nuts. And I mean, when you factor in Animal Farm, I mean, look at this, man. I mean, these books are freaking flying off the shelf. So who's not? I don't know who's not producing it. But the facts are you only get for hardcover paperback for that kind of money just shows you. And then we looked at who's the chick. She wrote something about the guy from some band. What's that? Mumford and Sons or something like that. He gave a like on Annie No's book and he got kicked him out of the band. Crazy, man. Crazy. I mean, the fact that then someone had written something about transgenderism and that got banned off Amazon. Nuts. Just because it wasn't supporting the narrative. It's freaking scary, scary stuff. So buy your hard copies. And if you look, guys like Von Mises, you know, he's not going to be banned tomorrow. You don't think, though? Because the commies want him dead. The commies want Ludwig von Mises dead. Crazy. Crazy. Get your stuff and be prepared, man. These guys aren't stopping at freaking raising taxes. I'm telling you, man. We've seen this. Every socialist is a disguised dictator. That's why they call them watermelons. Because the greenies are green on the outside, but they are deep, deep red on the end. They want to control every aspect of your life. They do. And sadly, many people in America fall for it. It's nuts. Oh, if we just gave them more money for solar photovoltaic, we all live happy. We live in a happy land. It'd be great. Crazy, man. Crazy. Now, so look here. Miss Lydia says, $5.96 for a book. It better be good. And this is where socialism can never win. You know why? Because why is $5.96 the value of the book? Would Lydia pay $5.96 for it? Maybe, maybe not. Matters not. Because for her, the value isn't worth the $5.96. For me, maybe. But value is based on what you decide for it. It's not based on the production cost of the good. This is economics 101 for the Austrian School of Economics. I cannot, man, just going back to Carl Menger, if I can have my, it's around here someplace, my Carl Menger book. Oh. So I got the pocket book, got that for $2. This right here is what I read in college and what I keep because it talks about the value. This is what separated the Marxism fools from I'm not even going to say the capitalists, but from the free people. Because Menger says the value is the price you put on it. It has nothing to do with the inputs. It has to do with what you value it as. It's based on the individual, not based on the labor, not based on the freaking union. It's only based on you. So Lydia might say that, and she's right. For her, it has no value of $596. And even if it was a good book, she might say, this isn't that valuable. When I looked at this book right here from Carl Menger, when I looked at that under lock and key at the Mises Institute in the original German, the original thing, you know, that for me, that is, I mean, it's literally one step beyond looking below the good book from the good Lord Jesus Christ himself. If that makes sense. It's that fundamental for the freedom of humanity. Carl Menger's theory on value. It's insane. If you don't, and it's so easy to read, man. It is so easy to read. You know why? Because there's no mathematical concepts in here with freaking econometrics and stuff. It's economic-based philosophy. And economics and investment theory went off the rails in the 1950s when they all were desperate to be a science. They want to be a hard science. They want to be taken like a physics. They want to be. Do you know the guy from Tanzania, by the way, had a PhD in chemistry? I thought that was interesting because all these people say, oh, he's an anti-vaxxer. He's dumb. Well, he had a PhD in chemistry, not some fool. And I just thought that was interesting. The president of Tanzania, who said, yeah, I'm not so sure about these vaxxers. Not so sure about Bill Gates. He's an idiot. He doesn't know what he's talking about. Follow the science. He's a PhD in chemistry. Anyway, point being, economics and investment theory is all based on common sense, basically the humanization of it all, the philosophy. And then came along the 50s where all the money was being thrown into the sciences, chemistry, physics and whatnot, because of the war, because of Eisenhower, the military industrial complex, which he coined. And he also said the educational industrial complex. He didn't say that, but if you listen to his farewell address, that's exactly what he was addressing. We're going to get rid of the tinkerers in the garage. Instead, we're going to give it all through government contracts. That's not good. That's basically science is being corrupted by the academia and government. It was 100% right. Going from Ansel Keys all the way down to the Michael Manns of the world, all the way down to climate change people, the food pyramid people, the vaccination people, all the way down. There's one big S show. And as such, money talks and BS walks. That's just a fact. Anyway, so if you look at Menger, and you say, okay, what happened to investment theory? What happened to economics? Well, they got physics envy. They said, we got to be a math like those guys. That way we can get that sweet, sweet government money. And so they all started going into these crazy investment numbers, crazy graphs, crazy calculations. And lo and behold, no one gave a rat's butt anymore about it. And that's why I say, Black Scholes, oh my, it's just the capital asset pricing model. All this stuff is foolish, man. You shouldn't. I mean, like, if you want to follow, I don't care. I literally don't. I just find it funny because investment, if anything, is basically luck, essentially. Not all the time. But you think Ben Graham, you are the only person who's ever read Benjamin Graham who says, if I could buy a stock that's trading less than its cash, that's a good buy. You think you're the only person who knows that now? I mean, my goodness, man. That inherently makes sense. If you can buy a stock that trades at $1 a share and there's $2 a share of cash alone, you should buy that stock. That's value. That's what Ben Graham was talking about back in the old days. That's before all the calculations came along. Now it's, our capital asset pricing model says, blah, blah. Yeah. Anvil, kaboom. Anyway, so that is what, so fundamental about I cannot stress enough how wonderful the economics, the humanity of economics is freaking so beautiful because it's so individualistic. It says, the value is based on you as a God-given person. It's, how does it not make you just sit there in awe of the world we have, the human beings in it? We'll all have their different preferences. We're all making decisions, discriminating a million times a day. Do I want to buy this book or do I want to buy 2 of them to give away to my audience? Because they're $2 each at the Mises Institute. If I want to buy this book, this was free. Should I take 10? I was like, I don't want to take 10 because I don't want to ship them out. But I'm going to give I guess, I'm going to raffle this off to my Subscribe-Star supporters because another classic book. You should see all the books I wanted to buy. I said, man, old ball and chain is going to kill me. And then I started thinking about her dad had all these Russian books because he was a translator for DOD and he spoke Chinese. He spoke Russian, Italian, German. My wife's mom spoke Chinese. And it's just funny because he's 6'4", she's 6 foot, both white as, pale white. Now she's from California, so she's a little bit tanner. He was like Mick through and through, my wife's dad, who I'd never met. Anyway, so a 6'4", pale white guy, Irish without question, and speak Chinese with the best of them. It's kind of funny. I've always wanted to see that George Costanza, where he goes and gets his gets a manicure by the Vietnamese people or something like that, or the Koreans, I can't remember. He starts talking, they're like, whoa, what the hell? I've always wanted to see that with my wife's dad and mom, because she spoke Chinese too. Anyway, when her mom died up in Virginia, we went up to clean out the house, and there's just up in the attic, just all this plethora, a treasure trove of books. Unfortunately, most of them were in Russian. I couldn't read them, but it's like, commie propaganda. That's all history, man. That's history right there. Ekaterina, who just talked, she was in the USSR while the commies were rampaging. It's crazy. I got people on my channel I've met through the course of my career, actually, who suffered on the Stasi of East Germany. I said, man, I wish you'd write about this. This cannot go. This has to be remembered. Everyone focused on Hitler. I mean, hell, we got 8,000 million things about World War II and Hitler. Very, very few on the Stasi in East Germany, on the Red Guards, never mind the Maoists and all that. It's just, we don't have enough of that. And so now they say, oh, you like Trump, you're a Nazi. It's the freaking stupidest thing that ever occurred to mankind. But I've heard that since day one. When I remember going down into Richmond, Virginia, on the day of the election, against Clinton and George H.W. Bush. You know, all these people were calling us Nazis, throwing rocks at us. And so I was like, oh, if you think George H.W. Bush is a Nazi, what? He was the head of the CIA. It's crazy. Anyway, so some people are saying, what the Democrats done? Look, the Republicans too, man. Let's not. You can use Libby. The books are free. Yeah, I think I got Libby on here, Lydia. I think I got Libby on my. Yep, I do. Got Libby right there on my app. Yes, ma'am. Yep. It's down there someplace. Right there. Libby. Yep. There's my Rush Limbaugh app. Rest in peace, Rush, man. All right. Let's see. Michael Mann. Oh my goodness. You don't know who Michael Mann is? Yeah. Hey, thanks, Peter. All right. Is climate change real? Is it man-made? I don't think anyone would argue that climate change is real, Peter. I'll take your $5. Much obliged. And I would argue inherently that climate change is not man-made. It's silly to say climate change is man-made. Are humans hurting the environment? Yes. I don't have any qualm acknowledging that. Are humans, is climate change man-made? The silliness of that argument cannot be laughed at hard enough. It's not. It's just, we're going to go into this real quick because it's fun. 2,000 parts per million of CO2 before man was here. Interesting. 2,000 parts per million CO2 before man was stepped foot on this planet. Now it's about 400 or so. Interesting. Which is up from 200 or so about 100 years ago. Interesting. Climate change is always based in CO2, which is stupid. Stupid. Climates change all the time. All the time. 4 times a year, climates change. Stupid. Dumb. Don't. You look like a fool saying that man is causing climate change when climate change became before man did. Predecessor, whatever it is. I can't think of that word. It's dumb. Now, does man cause human environmental chaos? 100%. I don't disagree with that at all. Don't disagree in that at least. In fact, agriculture is bad, man. Mass agriculture, monoculture, without question, is bad. Without question. Paving the roads, inherently bad. I wish we didn't pave so much. I get it, man. That's not good. And not that, just how ugly it is. I mean, you go through freaking Atlanta, and just, oh my goodness. Go through Atlanta, you just see nothing. You don't see any trees. How do these people live in Manhattan? No trees. They got Central Park. Dude, trees. We need trees, man. Trees are wonderful. And I'm sitting there thinking, all these Manhattanites going to tell us about freaking environmental chaos when you got no trees? You got nothing but freaking cement and concrete and paved roads? Screw all that, man. All right. Well, so, John Beckham, right on, man. There's my man John. Give me $5. I appreciate y'all. That's all fantastic. All right. So you also asked a question. All right. So my man John, that's a pretty cool drawing there, whatever that is. I can't tell, but I like it. He says, when you say nearing retirement, how many years are we talking, specifically when to protect assets prior to leaving his crappy old job? I usually say about 2 years, man. And the reason I say 2 is because we got to protect. See, it's tough because you're making a salary, so inherently you're not pulling money out. But at the end of the day, we got to protect the 2 years before you hang it up and the 2 years after. Because even though you're not pulling money out of your portfolio while you're still working, we don't want you to retire and have to pull money out of a portfolio the day you retire, the markets are down 50%. I hope that makes sense. So basically, you have $100,000. You're 2 years out, $100,000 in stocks. All right, you need 20,000 a year just for simplicity. All right, you're like, all right, well, I'm making money. I'm getting that $20,000 from my income, so I'm going to keep plugging away into stocks. And then all of a sudden, the market falls 30%. So now we're down to $80,000. Right, but now you're retired. Well, you're still down to $80,000. You got no money coming in. So how are you going to protect that if it happened while you were still working and you're still plugging in away? You're plugging, but the market fell more than the money you're putting in. You can't have that. So what we have to do is you have to say, look, 2 years out, we cannot afford the decline even in those 2 years, even if you still got money coming in, because the markets just don't bounce back the next day. I mean, what happened last year, from February to March has never happened like that before. A 33-day decline, that's freaking nothing, dude. We got to make sure that if you retire, and if you're, so in 1998, here's old John. He's working. He hates his crap job. He says, look, man, I can't afford a market decline like what happened in 1973 or 1974. So I'm going to go ahead and I'm going to lock, essentially 4 years of cash away, if that makes sense. Or you can lock 2 years away and just for the next 2 years, just plug in the cash. Either way, I'm going to have 4 years of cash is my goal. All right. So that way I can take money off the table in 1998 when the markets are way up. Now I'm going to miss some, right? Because I'm going to pull a decent amount, 20% of my portfolio essentially out of the market. I still have 80% going up if the markets do go up. But essentially I've secured 4 years of income essentially in cash. So that way, once I retire, and I retired 2 years later in 2000, and the market's going down 9, 11, and 22% respectively, I don't have to pull from that. I can pull from my cash. So I got 2 years before I retire. I'm still making money. I'm just locking it in so that way I don't go into a buzzsaw. I cannot stress this enough because I'm telling you, even if you retired in 2000, if you had pulled the money out in 1998, you saved yourself a lot of turmoil. You really, really did. If you retired in 1998 and you had 4 years of cash, you saved yourself a bunch of turmoil because you still were able to sell in 1999 at a stock market that's high, and you still had 4 years of cash to cover you for 2001 and 2. And then in 2003, you still had money to cover you in cash. You can let the markets rebalance themselves. Don't forget, though, Wellington and Wellesley did fine in 2000, 2001. It's just in 2002 they got killed. And not even, killed is not even killed. They got knocked around a little bit. So 2 years. I hope that makes sense, man. Yep. Climate changes every day. Climate has been changing before humans existed. It's a fact. Yeah. Military. I got the vaccine. I still got something to show for it. When we went to I can't remember where we went. We went someplace and they made us get vaxxed. Yeah, Lydia doesn't. I don't get the flu shot either. It pisses my wife off. And I said, well, just not gonna do it. Because she's starting to see the light. It takes time, man. It takes time. And it's good. And so remember, folks, you can't make people see your light. They see it at their own accord, if that makes sense. So don't try to change people. Just try to be, you gotta be the lighthouse out there. You are the light. You are warning people of the risk. Whether or not they want to be warned, it's up to them. They can still go crashing into the rocks. All you can do is warn them, and hopefully at some point they see the light. My old ball and chain, man, she was, I don't want to say left, because we're Catholic, and so we're anti-abortion. That's just a fact. Sue us. And she always wanted a big family. I always wanted a big family, so it was all good. But she's pretty on the left. Not gonna lie to you. But slowly, and she's come over because A, the left has gone nuts, but B, she just sees common sense, man. You start having kids, you start making, you start working, all that, and just common sense dictates. So kids out of college, of course they're gonna be left. They've never done anything. Once they start working, once they start having families, it's funny. Everyone is conservative for the things they know. You see what I'm saying? Everyone is conservative for the things they know. Their family, good schools, safe neighborhoods. You see what I'm saying? Their family, it's their protection. everyone is conservative, i.e., they're going to buy firearms to defend their families because when seconds matter, cops are only minutes away. Everyone is conservative with the things they know. Taxation. Very few people volunteer to pay more to the IRS. It's interesting now but they don't mind saying, "Don't tax me, don't tax you, don't tax me, tax that guy behind the tree." Very few liberals stroke bigger checks to the Treasury Department. Very odd. So remember, everyone is conservative in the things they know. So what happens is you got to let that conservatism work its way into the brain capacity up here. It won't always, but for you to get frustrated, like Cartman, how can I reach these kids? How can I reach these kids? You see that in South Park? It's classic. Actually, one of the guys yesterday, I forgot, what the hell was his name? Steve Mariotti, I think. He did some entrepreneur training for kids in the I think South Bronx, and it's just funny. He's like, so he's a kind of short white guy going to these South Bronx places in the 80s and 90s. He goes, man, I didn't know how I was going to reach these kids, and I just started cracking up. Cartman, how do I reach these kids? That's exactly this guy said, but he didn't say it like South Park. He said, I didn't know what I was going to do. I'm a white guy going to the South Bronx. How am I going to reach these kids? And it's actually kind of funny. It was just cracking up. Anyway, he did a good job. He reached some kids, and some of them became entrepreneurs. Fantastic. He had a story. He drove Hayek. Oh my goodness. This is just like, man, I don't know. It's like if you like Alabama football, and I don't know why you would, but if you did and you got to go see, Paul Bear Bryant, you know what I'm saying? And freaking, oh my goodness. It's just like the same thing. You'd be like, holy crap, there's Paul Bear Bryant. You know what I'm saying? It's nuts. And you're sitting there thinking, whoa, the Packers, Vince Lombardi, Newt Rockne for Notre Dame. I mean, Matt, it's like, dude, it's crazy. Anyway, he's telling a story about taking Hayek from the airport. Hayek. I'm sitting there thinking, this guy drove him from the airport. Hayek. It's crazy. Oh, I love it. There you go. All right. James says, right on. I think people, yeah, I agree. All right. Right on, Lydia. Sad to see when people cut trees. Freaking plant a tree or die. There's literally, if you guys hold on just a second. If you guys are looking for some good energetic music, you could always turn on right here. Out of Boston comes Tree, the 1994 album Plant a Tree or Die. You can listen to that. Plant a Tree or Die. Let's see what songs are on here, shall we? This is the one with Negative Hippie. Yep, Negative Hippie. Right there. Negative Hippie, Freedom Rock. Yeah. I don't know what this is. So good, man. Surf AIDS. All right. Some good stuff. If you want trees, you got to plant a tree or die. Completely agree. I saw those guys a couple of times, once in Boston, once in D.C. Actually, where I took Charlotte, one of our first dates. She went with one of her friends, and I went with one of my friends. And we were going out, and then we're trying to blind date these two. And I don't think they kicked off. And so Charlotte and her friend sat in the back, drinking at the bar, or whatever. I don't even think she's 21 yet. I was probably robbing the cradle. Anyway, she goes, yeah, then it's interesting. We're coming back. She goes, yeah, and I look up, and there you were on the stage diving off. And that was pretty interesting because she had never been to that kind of show before. She goes, yeah, it's pretty interesting. We'll see you later. I said, oh, is she ever going to call again? And she didn't, so I called her. I said, hey, what are you doing? She goes, oh, yeah. And somehow with my fascinating pearly yellows and my ability to say, I got some serious money, marry me, babes, I'm rich, and she fell for the spell. She fell for the spell. 30 years later, she's starting to wake up. She goes, what the hell am I doing with this clown? Where's all this money he promised? Where's his pearly whites? I noticed they're yellow. But 4 kids later, I'm stuck on her like white on rice, man, or stink on poop, if you know what I'm saying. All right, so oh yeah, look, they're gonna mandate it, dudes. I'm telling you, it's gonna be mandated because everyone fell from the everyone has fallen for this idea that vaccines are the save all. It's crazy. I believed it too. I believed it. I'm not saying I don't believe it. I'm just saying I'm agnostic. But the minute you say, is there another point of view in vaccines? Everyone beats you down with a freaking baseball bat. It's the weirdest thing. Same thing with climate change. I'm telling you, just tell people you're not going to have solar running your economy. It's the weirdest. It's the faith, man. You cannot call someone's God that doesn't exist. You can't. And this is where Christians made a huge mistake as well. I grant that 100%. And Catholics in particular. I was raised Catholic, so I don't know what other denominations. I just know Catholics. You question anything about Catholicism, you're going to hell. You're like, why? Because some priest said, what the hell? What's his qualifications? Because he has a white thing right there? That's not enough for me, man. I'm a cynic. I'm a skeptic. I need more. I need more than just some freaking clown in a black thing with a white thing right here. That's not enough. If you ask a question, that just means you're thinking. You're a thinker. But how dare you? My granddad used to get pissed. This when you ask anything about the church, because he's raised that the church is all, the Pope is infallible. That's the hell he is. No, he's not. He's a human being. Ain't none infallible other than the one. Mary's not infallible. The only infallible one is the one, Jesus. That's it. That's it. And some Catholics get really upset. They think the Pope is. I said, well, how's the Pope? Human beings are the Pope, and human beings select the Pope. It's a vote. Yeah, right on. I don't know if I follow right on. The Protestant Revolution. Exactly. Crazy. Yeah. Anyway, I got to trust me. I married up, brother. I married up, man. Jill, she didn't get a prize. Trust me, man. Trust me. It's funny, actually, because Metal Church. Dude, I love Metal Church. I listened to the Beyond the Black. I think that's the album, Metal Church, for the first time like 2 months ago. I was like, damn. That first singer of Metal Church, I didn't realize how good that guy was. I forgot his name. I think he died. But man alive, that guy was good. Anyway, so long story short, yeah, you have to get a permit to plant a tree. Anyway, they're gonna mandate the vaxxes. It's coming. When Israel, I guess I shouldn't be, has a green passport. I'm like, Israel. I'm starting to lose my faith in. Look, I always am an Israel supporter. Not so much anymore, man. Look, I support them, as much as anyone else. They're all in it, man. They're all a big part of it, and it's Israel of all countries. That'd be the least one that should have a green passport. It's frightening. It's crazy. Oh, you're anti-vax. Well. Look, I've heard that so many times. Oh, you're anti-green energy or whatever it is. You're pro-climate change. The whole thing's just stupid. Boring. Just come on, man. It bores me. Oh, you're anti-God because you challenge what the priest says. We need more skeptics and less, yes, sir, yes, sir, yes, sir, less adherents. We need more skeptics. The funny thing is, the more skeptical you are, the more faith I've become in Jesus. Not so much the human beings that, as even C.S. Lewis says, the biggest barrier to Christianity is the church itself. That's C.S. Lewis. Because of the failure to understand the relationship that we have with God. Now, I can't explain the Trinity to you. I don't know. I just know I love Jesus and Jesus loves me. That's good enough for me. God wants a personal relationship with me. I know my heart says Jesus rose from the dead. And I also know that the freaking, Peter, all the freaking apostles, they all denied Jesus, even though they saw the miracles he performed while he was alive. Yet somehow, not only did people who saw his miracles while alive denied him, they all willingly sacrificed their bodies under horrible torture, the worst ever, the crucifixion, excruciating pain, because of Jesus, the same guy they denied while he's alive. Somehow, out of nowhere, they say, yeah, okay, put me up on a tree and hang me upside down and freaking hammer me into that. Peter. And the same guys who said, no, I don't know that guy. Pretty amazing, if you ask me. Something happened. Something happened that made them turn. Well, it's all fake. Okay, that's fine. Whatever. It's always fun to say when people say, Jesus didn't exist. Oh, so you're saying the Quran's wrong? Because no one's going to ever say that because they don't have the guts. So it's okay. All right. Jesus doesn't exist. So the Quran is incorrect. Because it's easy to bash Christians. No one has the guts to. It's funny. I say that all the time, and people are, well, what does that have to do with that? I say, why can't you just admit it, man? If you think Jesus doesn't exist, that means what exactly? Because don't be bashing Christians. That's easy, dude. I mean, you can. Hell, we've seen it all. It strengthens the faith, actually. It makes you a better apologist. And again, an apologist means you're a defender of the faith. That's what apologist to Christianity is. You got to defend the faith, but you got to learn the faith to defend it. And it's hard to learn the faith if you're always on freaking Facebook arguing about Jeff Bezos and Mark Zuckerberg. You got to read. I'm the biggest hypocrite here. Trust me, I am. I mean, I go in these patterns. Sometimes I get knee deep into it. Sometimes I don't. And it's when I don't get knee deep in the Bible is when I can feel my frustration grow, and I got to get back into it, man. Anyway, all right, so that's good stuff. I appreciate y'all being here. Just as an FYI, if all right, good question. So here's Rodolfo de Andrade. I just like Wellesley right now. If you're close to retirement, I just right now I like Wellesley. I just do. The bond stuff doesn't bother me very much, Rodolfo, because as we saw today in BND, the total bond index, it was down off 3.5%. That's nothing, man. That's no big deal. The bond stuff doesn't concern me all that much. The stock stuff is what concerns me. Yeah, and the year we've had from not calendar year, from last year at this time to now, a 75% increase in the market is nuts. And that just tells me, on top of the decade we have previous to that, that's not sustainable. Now, that does not mean we're all going to go to hell and burn. It just means there's going to be a reckoning, and we don't want that to happen the first 2 years of your retirement. We just don't. Just real quick, I just had to make it funny here. Notice who wrote the foreword on this. Douglas E. French. Douglas E. French. Does that Douglas E. French, does that make you laugh like it does me? And if so, why? Why does that make oh man, Douglas E. French? Anybody? Anyone make you laugh? Oh, why get out of bond funds now? I mean, the interest rates have already gone up a lot. Yeah, I have to look at bullet shares again. I did a video on those 2 years ago. This is the ADD investment chat. All know the jumping around, how our brains work, and why we connect with Josh. Yes, indeed. Yes, indeed. We all need to take. I don't know what's the stuff they give you for ADD? I don't even know what it is. All right, ready, Jeremy? So Douglas E. French. You know, Doug E. Fresh, man. Doug E. French. Doug E. Fresh. How could you be How could you not see that? Dougie Fresh, Dougie French. How funny is that? That's funny. Douglas E. French. My first thing was Dougie Fresh. 6 minutes, Dougie Fresh. You're on. 6 minutes. 6 minutes. Look at that. That's Dougie Fresh. Douglas E. French. And I guarantee old Douglas E. Fresh, if he's still around, has no clue how funny that is. That's awesome. Dougie B right here. Yeah, I dig Elon Musk. No, it's not a stretch. That's a Dougie Fresh wrote the foreword for Lily Love Beasts. I got no qualm with Elon Musk. I don't know. I don't pay all that mind to him, but I like the fact he's willing to be independent. I like it. I just like independent thoughts, Lydia. That's why I like you, old Lydia, on here. She's independent. She has her own thoughts that disagree with mine, so she's wrong. But it's okay. It's okay to be wrong. But anyway, just anyone who can think for themselves, I like. Just think. And if you can think about it, dude, it's not funny if you don't know who either guy is. That's why you're here, to learn, man. Now you know Dougie Fresh, and now you know Douglas E. French. Interesting. No, man. He doesn't want to ban gas vehicles, does he? Nah, dude. Q Humor, same guy told me I flipped out on the market decline in March. I don't know, man. I'd want to see that. I'd want to see that in writing someplace, brother. All right. Oh my goodness. Yeah, don't get out. There's no reason to get out of bonds now, for heaven's sake. Why? Because they got knocked around a little bit. No. Now you get a better yield for it. I did a video on bullet shares, Mr. Wrestling. It's been a couple years. I also did videos before on I don't like any of that crap, man. Crispy bacon? Crispy bacon. Oh, that's classic. That is crispy bacon. No, I don't. Do you know Amanda Hug and Kiss? Oh, man. What was I getting ready to say? I'm not a fan of the carbon tax. I hate it. Someone had said, anyway, so going back to bullet shares, and we'll go. The bullet shares, I was kind of negative on them. And then I don't know, I'll have to revisit that. I was also negative on fixed index annuities too, a few years back, probably even last year. I have second thoughts on that now. And again, because your long-term portfolio shouldn't change much. It shouldn't. Your long-term portfolio should stay the same, but is your short-term, i.e., going from the accumulation phase to the decumulation phase, where you go from plug and now you're on the precipice now. That's a whole different portfolio. It is. And I don't understand why people, not you guys, but people say, well, my long-term, I should still be 100% stocks. No. I mean, maybe, I don't know. But I'm just saying it's two completely different Joshes. One, I'm plugging. The other, I'm taking. That's two completely different long-term perspectives. Not to see the difference is boggling to me. And so if I'm sitting here today, I'm not changing. And I wouldn't recommend anyone change their long-term, heavy stock-oriented investment portfolio unless they're right at that precipice. Remember, a precipice means you're just on the top, you're looking down. All right. It doesn't mean it's going to crash. It just means you're looking down at the potential for that to happen. I don't know how someone could not at least think about changing that perspective. It doesn't make you weak. Oh, you're a wimp. You got out of stocks. And I'm not saying get out of stocks. Right now, I prefer Wellesley for people who are in that time frame where they're about to change. I really, really do. And even if you're in retirement now, I'd say, it might be a time to pull back some. If you're still plugging away, I don't care. All right. Yeah, my wife's going to come to put me to bed soon. Yeah, Musk is South African. That's right. He's an African American. All right, my friends. Adios. We'll see y'all. Appreciate you being here. Much obliged. And if my man James is still on here, send me your address, and I will send you this book. Thanks, guys.